previously recognized financial instruments from entities statement of financial position. A company had issued debentures, but now those particular debentures have been removed from the statement of financial position. They will no longer be shown there as a liability. That process we refer to it as the derecognition. Now, when can the financial instrument be derecognized? We have various criteria upon which the financial liabilities can be derecognized, of which in this case we are going to look on the derecognition criteria for both the financial assets and also the financial liabilities. But even before we look on the criteria here, you have to recall what is a financial asset. A financial asset, basically, I've said that this is a investment in a debt instrument. Investment in debt instrument. For example, if today you have some cash in your bank, instead of money staying there, you may decide to invest in government securities. You go to you buy government securities having a value of 1 million, and then you'll be earning some interest. Once they mature, you're given back your money. So that investment in government securities to you is a financial asset. Sasa? Yes. So a question then arises: when should the company remove financial asset from its books of accounts? There are two criteria when that may happen. One is when the entity transfers the rewards and the risks associated with the financial asset. When the entity transfers the risks and the rewards associated with the financial asset. What does that mean? And let's assume that we have a company here, company X, and this company has invested, for example, in debentures of another company. So to this company, we are saying that investment in debentures is a financial asset. So when should this company, or when can this company remove those financial assets from its statement of financial position? One of the circumstances when this company transfers the risk and reward. So generally, what we know, anytime you have undertaken an investment, anytime you have invested, there are some rewards, there are some risks associated with that particular investment. But when can you transfer those rewards and risks? So to transfer is basically when you sell. So meaning that once this company sells this particular debentures, then we say that the company has transferred the risk and rewards. It is obvious that once you have sold an asset, you cannot continue showing it in your balance sheet because it has already been sold. You have transferred the risk and rewards. Yes, so I want us to look on that topic of the borrowing costs. And as far as that topic is concerned, we're going to look on, first of all, to define what is borrowing costs. How do we compute the borrowing costs? And how do we equally proceed to account for that particular borrowing cost, of which you're going to see that the computation, the accounting of the borrowing cost, basically this one should be done in accordance with the International Accounting Standard number 23. So I think those are basically some of the aspects we are going to discuss in this topic here. The borrowing cost. So as the name suggests, borrowing cost, this basically refers to the costs which are incurred by the company, that is the interest and any other cost which is incurred by the company in connection with what? In connection with the borrowing money, either to purchase an asset or basically to do what? To acquire an asset. To acquire what? An asset. So generally what we know is that if the company, for example, intends to construct an asset, maybe to construct an asset such as a building, or even to do what? Or even to purchase an asset, so that company may not be having cash. So meaning that our company here may be forced now to go to the bank and basically borrow a loan for the company to be able to get money to acquire that asset or even to construct that particular asset. So that particular interest now, which will be paid by the company in connection with that particular loan, together with any other charges connected with that particular loan, we refer to that as what? We refer to that as the borrowing cost. That's why we're saying the borrowing cost. This is the interest, and other costs, and other costs related to the borrowing, related to borrowing of fund, or basically money to do what? To acquire, or even to do what? To construct, or even produce a qualifying asset, or even produce a qualifying what? Asset. The interest which will be incurred by the company and any other cost connected with the borrowing of fund, and that fund is to be used by the company to acquire, to construct, or even to produce a qualifying asset. That is basically a borrowing cost. Now, what is a qualifying asset? Because in this case, we are referring to a qualifying asset. So basically, a qualifying asset, we say that this is an asset whose construction basically will take a substantial period of time. If, for example, the company constructing a building, and maybe the construction of that building will take more than 1 year. Will take more than 1 year. That is regarded to be a qualifying asset. So therefore, this is basically an asset, whose production or even construction takes a substantial period of time, over time. And basically, in this case, when we talk about a substantial period of time, this is basically a period of time which is more than 1 year, So mean that if a company is constructing a building, and the construction of that building basically will take a period of more than 1 year, year. For that building to be completed, it will take the company 1 year to do what? To complete its construction. That is a qualifying asset. So if the company therefore borrow money, for example, through acquiring a bank loan, through the issue of debt instruments like the debentures, so the interest which will be paid on that bank loan, the interest will be paid on those particular debentures plus any other cost, that one is regarded to be a borrowing cost. Now, how do we account for this particular borrowing cost? So the borrowing cost is borrowing, foreign currency borrowing. So what do you mean by, first of all, the foreign currency borrowing? So this whereby a company borrow money, but in a foreign currency. For example, maybe a company borrow money in US dollars. So automatically, if it is a Kenyan company which has borrowed money in US dollars, that amount has to be recorded in the company's books of account, not in US dollars, because the company prepare its books of account and also its financial statement in Kenyan shillings. So in the process of translating this loan, into Kenyan shillings, there is an exchange gain or something called an exchange loss. That exchange gain or exchange loss, which essentially is an exchange difference, is still a good example of the borrowing cost. So, but now this one arises whereby the company has borrowed money, but in foreign currency. Now, these are basically good examples of what you refer as a borrowing cost. You may come across that particular question whereby maybe you're required to define what is a borrowing cost, and can you give good examples of what? Can you give good examples of the borrowing cost? Give good examples of the borrowing cost. Now, next, I want us to proceed and look on how do we determine the borrowing cost. Computation of what? of the borrowing cost. Computation of the borrowing cost. Now, remember, borrowing cost essentially we have said is the interest and other costs which are incurred by the company in connection with borrowing of money to finance the construction, the production, or even the construction of a qualifying what? Asset. So how do we determine this? So to determine this, we compute the interest which is payable, the interest which is payable. So how much interest is supposed to be paid in connection with that loan which has been borrowed? But now to this, we less interest on money invested temporarily. Invested what? Temporarily. What do you basically mean by that? Let's assume that our company here, for example, has borrowed like 2 million or maybe 20 million. So, but maybe all that amount, or the 20 million is not invested, all of it is not invested in the project at once. Maybe the company initially will require like 15 million, and maybe the remaining balance of 5 million will be injected in that project maybe after 6 months. So basically being a finance manager, it is not good that money to be kept somewhere in the bank account, to be kept in the bank account. So you can take that amount, you invest it temporarily. For example, you can put it in something like money market fund. I hope you understand what a money market fund. These are short-term investment vehicles. So instead of keeping money idle in your bank account, put it in a money market what? A fund. It will basically give you some interest, maybe for those 6 months, and then you withdraw it whenever you need that amount. That amount of what? Of money. So therefore, that amount which has been invested temporarily, it will be earning some interest. So therefore, what you do, you compute the interest which was supposed to be paid in connection with that loan, and then you do what? You less any interest which has been earned. Yes, so December 2024, question number 4, and we are told the following are the consolidated financial statement of 𝐉𝐎𝐂 Limited or 𝐉𝐎𝐂 Group, that is, for the year which ended 30th of September. We are given the consolidated statement of financial position basically on 30th of September 2024 and 30th September 2023. So we have non-current assets which include PPE, goodwill, investment in associate. Under the current asset, we have inventory, account receivables, cash, and cash equivalents. And then we have the total assets. Then at the equity, we have ordinary share capital, share premium, revaluation surplus, retained earnings, and then we have equity attributable to the group owners. We have the non-controlling interest and the total equity. Then we have non-current liabilities, which include bank loan and deferred tax. And then at the current liabilities, we have account payable and current tax. Then we have the consolidated statement of profit or loss and other comprehensive income. So we are given a revenue, cost of sales, gross profit, operating expenses, a profit from operation, the gain on disposal of the subsidiary. We have the finance cost, share of a profit of associate, profit before tax, income tax expense, profit for the year, and other comprehensive income, which is gain on property devaluation. We have total comprehensive income for the year, and then the profit for the year has been split into two: profits attributable to the group owners and the profit for the year attributable to NCI. The same case, total comprehensive income have been split into two: attributable to the owners of the group and attributable to NCI. We have additional information, basically from note number 1 all the way to note number 6 and note number 3, that is. And from that information, what are we required to do? We are required to prepare a consolidated statement of cash flows for 𝐉𝐎𝐂 Group for the year which ended 30th of September 2024 using indirect method in accordance with IAS 7. So marks allocated there were 20. So basically, before we do that, I want us to go through the additional information we see. Is there any working which is required? So let's go straight to note number 1. And for this particular question for group cash flow, it's not a must you come up with a group structure. What you have been doing for the other word, a question, not a must. So number one, you're told that depreciation of 2,400 million was charged during the year which ended 30th of September 2024. So this is a non-cash item. This is one of the items you're going to adjust to our profit. So no working there. And then you're told plant with a carrying amount of 1560 million was sold for 1720 million. The gain on disposal was recognized in operating costs. And then you're told the property was revalued, or property was revalued during the year, resulting in a revaluation gain of 1,400 million being recognized. So if we go back to the income statement, to the consolidated statement of profit or loss, below the profit for the year, I hope you can be able to see the profit for the year, which is 5290. I hope you can be able to see that. Below that, we have other comprehensive income. And basically, that includes the gain on property revaluation. So this is the gain on the property which was revalued. So I think what is required as far as that point is concerned is that we compute the gain or the loss on the asset which was disposed. So let's do that. That should be our working number one. Workings. So we start by computing the profit, or let's just refer to this as the gain or the loss onward on disposal. So basically, we know that once an asset has been disposed, we compare the sales proceeds with the net book value. So therefore, here we take the sales proceeds, So sales proceeds, remember, is the amount at which the asset was sold at. We minus its net book value, or basically its carrying what amount. So by applying this formula, if you get a positive figure is a gain, but if you get a negative figure is what? Is a loss. So in that case, we are told, basically in paragraph 2, a plant with a carrying amount of 1560 was sold for 1720. So the sales proceeds was 1720, but its carrying amount was 1560. So in this case, automatically it was sold at what? At a profit. And I'm told the profit here, this minus this, was 160. So this profit, remember, is we have said is accounted for as an income, but basically this is a non-cash item. So this one will be deducted from the profit. Yes. So basically, I think we have that, but automatically we will be able to come back to that information. There is an account we are going to prepare to tell you which account. So we will come back to that. But as far as that point number one is concerned, I think we will consider like 3 items. We have 3 items to be considered in our cash flow. Depreciation to be added back to the profit. This gain to be deducted from the profit. And then the sales profit, 1720. This one will be considered in computing the cash flow from investing activities. So number 2, we are told during the year which ended 30th of September 2024, 𝐉𝐎𝐂 Limited, remember 𝐉𝐎𝐂 is the parent. If you go back to the information we have below in paragraph 1, we are given information about the group, 𝐉𝐎𝐂 Group. 𝐉𝐎𝐂 basically is the name of the parent. So we are told in note 2, during the year which ended 30th September 2024, 𝐉𝐎𝐂 Limited, which is now the parent company, acquired 75% of the ordinary share capital of 𝐻𝐍 Limited, paying cash of 9,400 million. So this is a subsidiary which was acquired. Remember, I've said once a subsidiary is acquired, what do we consider in our statement of cash flow? The net cash outflow. The net cash outflow. The cash which was paid minus the cash balance of the subsidiary acquired. So, and then you're told the non-controlling interest was measured at its fair value of 2125 at the date of acquisition. Automatically, anytime you're given that information, it basically means that when computing the goodwill of this subsidiary which was acquired, we are going to use the full goodwill method. That's why we're given the NCI at fair value. And then down here, we are told the fair value of 𝐻𝐍 Limited net asset at the date of acquisition was made up as follows. So we are given the assets and liabilities of the subsidiary which was acquired. The subsidiary which was acquired, that is 𝐻𝐍, had PPE, property, plant and equipment, inventory, account receivable, cash and cash equivalent, account payable, current tax, and then you're given the net asset of how much? 9315. So I think maybe the first thing we can be able to compute there Number one is basically the net cash outflow we are going to consider in preparing our statement of cash flow. So the net cash outflow, the net cash outflow. So the net cash outflow, remember I'll say that this one will be equal to the cash which was paid minus the cash balance of the subsidiary which was acquired. The parent company acquired a subsidiary, it paid some cash, but the subsidiary which was acquired, it came with some cash, which is a cash inflow. So in that particular, actually in the first paragraph, we are told during the year which ended 30th September 2024, 𝐉𝐎 Limited acquired 75% of the ordinary shares of 𝐍𝐿, that is 𝐍𝐿, paying a cash consideration of 94. So this cash consideration which was paid, remember, is a cash outflow. And then if we go to the information we have below paragraph 3, where we are given the assets and liabilities of that subsidiary which was acquired, you'll be able to see that subsidiary had a cash balance of how much? What is the cash and cash equivalent of the subsidiary which was acquired? Who can be able to see that figure? This subsidiary which was acquired, it had a cash balance of how much? It had a cash balance of how much? You can be able to see that figure. It had a cash balance of 500. So therefore, that is a cash inflow. Because once the parent company acquires the subsidiary, the assets, the liabilities of that subsidiary becomes assets and liabilities of the group. So that is a cash inflow. So cash inflow, we take it as what? As a positive. These are an outflow, these are an inflow. So the net cash outflow in our case is basically 89. Is that the case? 89. So this now what we are going to consider in our statement of cash flows. In relation to the subsidiary acquired, that is what we consider. Sasa, yes, not this amount, because majority of the students make a mistake and they only consider that. That is a mistake. So then also in relation to that, we need to compute the goodwill on acquisition. The goodwill on what? On acquisition. The goodwill on acquisition of 𝐍𝐿 Limited. So this one is quite simple. In fact, we don't have to arrange our work the way we were doing it in the other question. So we just do this, we just use a straightforward approach. So because we're using the full goodwill method, we will take the purchase consideration paid by the parent, which is within paragraph 1. Purchase consideration paid by the parent was 94. And then to this, what do we add? NCI at fair value. NCI at fair value is within paragraph 2, 21, 25. And then to this, we less 100% of the net asset of that subsidiary at the date of acquisition. And the net asset at the date of acquisition is given down there below paragraph 3 as 93.15. I hope you can see what we have done. We have taken the purchase consideration paid by the parent plus NCI at fair value minus 100% of the net asset which were acquired, because we are using the full goodwill method. That will give us the goodwill on acquisition, which I'm told will give us what? Are you getting that figure here? 21, 20, 22, 20. So please confirm whether you're getting that value here. Are you getting that value? Are you getting that value? That value is that's what you're getting here. So that is basically the goodwill on acquisition. So I think we are done with that. Let's move to point number 3, which should be the last point. We are told during the year which ended 30th of September 2024, 𝐉𝐎 Limited also disposed of an entire 80% ordinary shareholding in 𝐼𝐍 Limited for a cash consideration of 53. So this is basically a subsidiary which was disposed, which was sold. So, and actually we're given the purchase consideration which was received, or the cash consideration which was received, that is 53. And then you're told the subsidiary was not considered as a separate unit of the operation. Remember, if you can be able to recall what we said when we were looking on how we prepare the group account in case of disposal of interest, we talked about something called the full disposal. And actually, full disposal, we say that this whereby the parent company sells all the shares held in a subsidiary. We say such a subsidiary is actually regarded to be a discontinued operation. We say it should be accounted for in accordance with IFRS 5. And record, we say that what the parent company should do in preparing the consolidated statement of profit or loss is to determine the profit or loss from this discontinued operation. And this one we said should be considered as a separate item within the consolidated statement of profit or loss. But in this case, we are told when the parent company was preparing the group account, it never considered this subsidiary, which was fully disposed as what? As a separate item in accordance with IFRS what? F5. Sasa? Yes. So, but in this case, we just need to know there was a subsidiary which was fully disposed. We are given the purchase consideration there. And then in the last sentence of paragraph 1, we are told 𝐻𝐸𝐹 Limited had been acquired several years ago at 37.50. And then you're told the NCI of 20%. Remember the parent company, 𝐷𝐸𝐻, had acquired 80% shareholding in this subsidiary, which was disposed. It means that the percentage NCI was 20%. We are told in paragraph 2, the NCI of 20% was measured at fair value at 2,000 at the date of acquisition, and the fair value of 𝐻𝐸𝐹 Limited net asset was 4,600 million at that date. So I think also what we need to do here, even before we move to the other point, is basically to compute the goodwill, the goodwill of that subsidiary, that is 𝐻𝐸𝐹, yes, 𝐻𝐸𝐹, on the date of acquisition. So this goodwill, we are going to use it somewhere. I'll be able to tell you where. So, and equally this particular goodwill, we are going to compute it using the full goodwill method. We are going to use the same approach. We will take the purchase consideration which was paid by the parent. It is within paragraph 3, in note number 3, the last sentence of the first paragraph. The last sentence of paragraph 1, you're told 𝐻𝐸𝐹 Limited had been acquired several years ago for a cash consideration of 37.50. So this is the purchase consideration paid by the parent. In paragraph 2, we are given the NCI fair value, which is 2,000. So we have taken purchase consideration paid by the parent plus NCI fair value. And then in this case, we have less 100% of 𝐻𝐸𝐹 Limited net asset at the date of acquisition. In paragraph 2, the first sentence we are told, and 𝐻𝐸𝐹 Limited and the fair value of 𝐻𝐸𝐹 Limited net asset were 4,600 million at the date of acquisition. So this will give us the goodwill version. And basically, remember, this is the goodwill of the parent, the goodwill of who? Of the NCI. So that will give us what? No, Janet, that one is the purchase consideration which was received. That is the purchase consideration which was received. Can you read that point well? We are told during the year which ended 30th of September 2024, 𝐷𝐸𝐻 Limited also disposed its entire 80% ordinary shareholding in 𝐻𝐸𝐹 for a cash consideration. This is the money received after the disposal of that subsidiary. It is not the purchase consideration which had been paid on the date of acquisition. Are we together? Yes. So you need to understand that point. So that is the goodwill on the date of acquisition. Then, what are we going to consider in our statement of cash flows? We will consider the net, in relation to the disposal of that subsidiary, we will consider the net cash inflows. The net cash inflows. The net cash inflows, we have said that this one will be computed as the cash which was received, minus the cash balance of the subsidiary which was disposed, minus the cash balance of the subsidiary which was disposed. Now, if you go to the other paragraph, I think the last paragraph of note number 3, we are told at the date of disposal, the net assets of 𝐻𝐸𝐹 Limited were carried in the consolidated statement of financial position as follows. So we are given the assets and liabilities of this subsidiary which was disposed, that is Kifaru. Basically, what we need to check there for us to be able to determine this, was that subsidiary having any cash balance? Because we know the amount now which was received, which is given within the first paragraph of note number 3, and I think that is the figure Janet was asking about. This is the cash which was received. Our subsidiary was sold at how much? At 53. Was it having any cash balance as per the information we have below the last paragraph? This subsidiary which was disposed, was it having any cash balance? Was it having any cash balance? The last paragraph of note number 3, yes, it was having some cash balance of how much? Cash balance of 300. So remember, this is now a cash inflow. This is the money received by the parent company, but because it disposed that subsidiary, the group lost a cash balance of how much? Of 300. So therefore, the cash inflow, the net cash inflow here will be this, which is an inflow, minus this one, which is basically an outflow. So the net cash inflow here is what? Is 5,000. So this is basically what we consider in our statement of a cash flow, in our statement of what? Of cash flow. So I think basically, we can proceed and prepare our statement of cash flows. Then we will be able to do the other workings per need basis. We will be able to do any other working per need basis, because I think we are done with those particular notes. So let's just move and we prepare a statement of cash flows. A statement of cash flows. Statement of cash flows. So remember, okay, let's just have the consolidated statement of cash flows, which is basically for the year, which ended on which date? That is September 2024. That is of September 2024. So remember, here we need to determine the net cash flow from 3 activities: net cash flow from investing, net cash flow from financing, net cash flow from what? Investing. So basically that that's what we need to determine. So it is also advisable whenever you're preparing this particular statement of cash flows, determine those items concurrently. So have your 3 subheadings. So we always start here with the cash flows from operating activities. Operating activities, we need to have 2 columns here, and our figures are in million of shillings. In million of shillings. So here we have a number of items which we record. So make sure you leave enough space. We can leave all this space here. And then we have the other subheading for determining the cash flow from investing activities. Investing activities. Here we don't have so many items to be recorded here. And then cash flow from financing activities. Activities. So it is always advisable you have those particular subheadings, such that once you come across maybe an item to be recorded here, just record it. Yes. So let's start with this. And basically what you have said is that in computing the cash flow from operating activities, remember we are using the indirect method. Here we always start with the profit before tax. We always start with the profit before tax. So the profit before tax, where do we get this? We get this from the consolidated statement of profit or loss. So let's go to the consolidated statement of profit or loss. How much is the profit before tax? The profit before tax. Can you see that figure? Profit before tax. The profit before tax, yes, the profit before tax is 66 what? 90. 66.90. So we make a number of adjustments to this profit here, to this profit. So I've said always, the first adjustment which we make to this is the finance cost or the interest expense. Reason being, we should start with the profit before interest and tax, but basically you're not given that. So the first adjustment which we make to this profit is to add back the finance cost, which can also be known as the interest expense. And usually this particular item here is always above this profit. In the consolidated statement of profit or loss is always above that. So, and I hope you can be able to see that below the profit before tax, we have share of profit of associate, and then we have the finance cost. The finance cost in that case is what? Is 220. So basically by doing that, we have now the profit before interest and tax. Now, before we go to the additional information, there are basically a number of items which are given on the face of the income statement, which should be adjusted to this profit. Which are those items? Which are those items? Just above this particular profit here, profit before tax, we have something called the share of profit of associate. Now, this share of profit from associate, basically I've said this is a non-cash item. So the cash the parent company receives from the associate are the dividends. And basically that's what we recognize here. So what we will be able to do is that particular amount, share of associate profit, we less it from this because I hope you can see it is recognized there as an income. That's why there it is recorded as a positive figure of 720. We less it here because that is a non-cash item. And then we will compute how much dividends were received from the associate. That is now what we consider here. So that is the first item we adjust to our profit, and that is the share of profit of the associate. And basically that is an amount of 720. Because it has been added, we do what? We less it. We less it. Then above that, we have finance cost, which I've already considered. Above that, we have the gain on disposal of a subsidiary. Now, this gain on disposal of a subsidiary, it is a non-cash item, just like the gain or loss on disposal of assets is a non-cash item. And because that one has also been accounted for as an income and actually added here, what we need to do is we less it. We are lessing that this amount because it's a non-cash item. And then from there, we have the profit from operation, operating expenses, gross profit, cost of sales, revenue. No any other item on the face of the income statement will be adjusted to this. Then what you need to recall, we have said that to this particular profit, we need to make a number of adjustments. And the first adjustment will be for the non-cash item. Recall this acronym, 𝐷. 𝐷. So this one stands for depreciation on PPE. Depreciation on PPE, remember, this is something you're given in note number 1. In fact, we can just record that here. Depreciation on PPE. So in note number 1, depreciation of 2,400 million was charged during the year ended 30th of September 2024. So we have depreciation of 24. And remember, in this case, I've said that these first 4 items here, because they were accounted for as expenses, in arriving at these profits, they have been deducted, and they are non-cash items. What do? We add them back. Depreciation should be added back. So then here we have the impairment loss. Impairment loss on who? This is the impairment loss on goodwill. Now, the impairment loss on goodwill, usually the examiner will not give you this, so you have to compute that. How do we compute the impairment loss on goodwill? This one is computed basically by preparing an account which is called the goodwill account. Goodwill account. And basically, we know goodwill. This is one of the assets. So if you go to the consolidated balance sheet, under the non-current asset, you'll be able to see something called goodwill. So can you see the goodwill under the non-current asset in the consolidated statement of financial position? I hope you can see that. I hope you can see that. Under the non-current assets, we have the PPE, we have goodwill, we have investment in associate. Also, it is important for you to note that the current year ended 2024. But I hope you can also see that we're given figures for 2025. 2023. These are opening balances, whereas these are closing balances. So what we record here, because this is an asset, is the opening balance on the debit side. The closing balance, we record it on the credit side down here. Then on this side, we add a goodwill of the subsidiary acquired. Was there a subsidiary which was acquired during the current year? If yes, was it having a goodwill? You record it there. That increases the value of the goodwill at the start. On this side, we record the goodwill of the subsidiary which was disposed. And then from there, we balance this particular account here. A balancing figure on this side basically represent what? Impairment loss. That is what we're interested with. So can we record the opening and the closing balance of the goodwill? So the goodwill at the start of the year, remember you have said the figures in 2023 are the opening and the figures in 2024 are the closing. So the goodwill at the start was 11,560. The goodwill at the end of the year was 12,060. I hope you can see those figures in the consolidated statement of financial position under the non-current asset. Then we know that during the current year, there was a subsidiary acquired, there was a subsidiary disposed. So maybe we can start with this subsidiary. That is the 𝐍𝐶. 𝐍𝐶, this is a subsidiary which was acquired. As per note number 2, the parent company acquired a subsidiary called what? 𝐍𝐶. So it had a goodwill of how much? 2210. So this is the goodwill of the subsidiary acquired. During the current year, there was a subsidiary which was disposed, that is Kifaro. What was its goodwill? Its goodwill was 1150. So what we need to do basically is we balance our account. The balancing figure here is the impairment loss. In case there is a balancing figure. In case there is a balancing figure, that one would be what? That one would be the impairment loss. And I'm told the impairment loss here will be 560. Is that what you're getting? Yes, so that basically will give us a balancing figure of what? Of 560. So that 560 is what? Is the impairment loss. Is the impairment loss. Is the impairment loss. So we take what you have on the debit minus what you have on the credit, and we get that. So therefore, that basically how we compute the impairment loss on what? On goodwill. Then next, we have A here, which stands for amortization of intangible assets. So intangible assets should be part of the non-current assets. So if you check under the non-current asset, in our case here, we don't have any intangible asset. So it is obvious that we don't have any amortization. Then L here we consider the loss on disposal. The loss on disposal. Whether it is a loss on disposal of an individual asset or the loss on disposal of a subsidiary. Remember, the parent company sold an item of asset, there was a profit. Equally, the subsidiary which was disposed, there was what? There was a profit. So we don't have any loss on disposal. Then here we consider the gain on disposal. And remember this gain on disposal, this one, take into account it was added here, and it is an non-cash item, we left it. Remember, in note number 1, there was an asset which was disposed, and that is the plant, and there was this particular gain. This gain which we computed here, 160. So this one should basically be deducted from this profit because it was added, and basically that is what? A non-cash item. A non-cash item. So I think that's what we consider here, the non-cash items. So I think we have done with note 1, 2, and basically 3. 3, yes. I think majorly that's what we considered here. Nothing else. So then next we proceed and we consider the changes in working capital. The changes in working capital. And basically under the working capital, we consider 3 items here. 3 items here. Basically, remember, I've given this you acronym, receivables. I'll start for receivables. This one stands for inventory. And basically, this one stands for what? For payables. So if you can basically be able to record in the raw level, used to use a very, very simple approach. Like for receivables and payables, you are taking opening balance minus closing, opening minus closing, and this one closing minus opening. But in this case, because we have a subsidiary which was acquired, a subsidiary which was disposed, you have to do some computation here for you to be able to determine whether we have a cash inflow or a cash outflow. So what I want us to do, I want us to have some working relation to those three items: receivables, inventory, and payable. So how do we determine whether there was a cash inflow or outflow as far as these three items are concerned? One, we always start with the opening balance. This is basically how you work out whether we have an inflow or outflow as far as these three items are concerned. So to this, we add receivable, inventory, and payable for a subsidiary which was acquired. And in our case, we know there was a subsidiary which was acquired. In case there was a subsidiary which was disposed, you less its receivable, inventory, and payable here. And then basically you'll get now the net amount. You compare that with the balances at the end of the year. By doing that, you'll be able basically to determine, do we have an inflow or outflow? Yes. So let's record these balances. Here we'll start with the opening balances. So the opening balances, I get this from our statement of financial position. Can we go to the statements of financial position? And specifically where we have the current assets. Under the current assets, remember we are taking the opening balances. Opening balances are the values we have in the statement of financial position for 2023. The closing balances are the values we have in the statement of financial position for 2024. So let's take the opening balances. Inventory, avoid interchanging this one. Inventory at the start was 2780. Receivables, that is account receivables, was 2060. And then where do we have payables? Under the current liabilities. Can you go to where we have current liabilities? Under the current liabilities, payables at the start were 53. That is 45, 30. And then now to this, we will add the receivable, inventory, and payable for the subsidiary acquired. The subsidiary acquired, we are given that information within note number 2. The subsidiary which was acquired was SIBA. We are given its assets and liabilities within note 2. So its inventory was 940, that is the inventory. And then the receivables was 1500. 1500. What about payables? Payables was 1375. 1375. Then, do we have a subsidiary which was disposed? Yes. We have a subsidiary which was disposed within the last note. Note number 3. And actually, below the last paragraph. So the inventory for the subsidiary which was disposed was 1030. And then what about the receivables? Was 750. And for the subsidiary disposed, you can see that one should be deducted. What about payables? Payables was 510. 510. And then before we get the net amount here, I need to have the closing balances. So let me have the closing balances here. The closing balances, I'll get them from the statement of financial position. So I will start with the inventory, which is 2970. Account receivables is 2440. What about the account payables and the current liabilities? 4375. Now these are the closing balances, and then the amount which we get here, we consider that as the opening balance. Are we together? So this is the closing balance, and the net amount we will get there, we consider that as the opening balance. So having done, then we will be able to apply these formulas. We will be able to apply this particular formula. So let's, first of all, we compute the net amount here. The net amount, 2060 plus 15 minus 750. So I'm getting 28 10. I hope you're getting that. And basically we are saying now, this one is considered to be the opening balance. So being the opening balance, For us to be able to determine whether we have an inflow or outflow, we use this formula. For a receivable inventory, we take the opening minus closing. This is the opening minus closing. This minus that. If you get a positive figure, is an inflow. If you get a negative figure, is outflow. So we will apply this formula here. So the opening is what? 2810 minus closing, which is 2440. So in that case, what do we have? 2810 minus 2440. So I'm getting a figure of what? I'm getting a figure of 370. So that is an increase. Sorry, that is basically not an increase, that is an inflow. Because I've said by applying that formula, if we get a positive figure is an inflow, if you get a negative figure is what? Is an outflow. So and then what about the inventory here? I think I was given that figure there. The net amount 2780 plus 940 minus 1030, which is 2690. So basically which you're saying is our opening. So I'll apply the same formula, 2690 minus closing, which is 2970. So, and I think in that case, we will have negative 280. So remember that is basically a negative, is a negative, is a negative. So being a negative, that is a cash outflow. Is a cash what? Outflow. Sasa is a cash outflow. So then we move to payables. Payables, we have 4530 plus 1375 minus 510, which is 5395. So the, I need now to determine whether we have inflow or outflow. I'll apply this formula closing. I hope you can see here we interchanging closing, which is 4375 minus opening, which is 5395. So in that case, we will get what? We will get negative 10 what? 20. So therefore, that's basically how we determine the inflow or what? Outflow. So work out, first of all, these balances there. You consider those as the opening. You compare that with what? Closing. And then just remember those formulas there. Yeah. So having that then, we will proceed down here. We less the tax paid. And then the interest or the finance cost, which was paid. Finance cost, which was paid. So I think we can start with the tax. So for the tax, basically this one, we must prepare an account because for tax, we have so many items affecting tax. I want to do away with this. I hope we already have this in your book. So for the tax, basically we prepare an account. We prepare the account because we have so many items affecting this. We prepare a tax account. So what do we record here? So we go to where we have liabilities, specifically at the non-current and current. We check whether do we have a deferred tax, do we have current tax? So which are basically tax liabilities. So we do the same at the end of the year, deferred tax, current tax. So then on this side, that is on the credit side one, we have the tax for the current year from the income statement. We also have a tax liability for the subsidiary which was acquired. The subsidiary which was acquired, was it having any tax liability? And on this side, we have any tax liability of the subsidiary which was disposed. Then we balance our account. The balancing figure on this side basically represents the tax which was paid. So that's why I'm saying for this, you have to prepare a ledger account. So can we go to where we have non-current liabilities? In the consolidated statement of financial position, I want us to check whether we have a deferred tax in the consolidated statement of financial position. Yes, and I can see we have two liabilities, two non-current liabilities, the bank loan and the deferred tax. So the deferred tax at the start was 650, and then the deferred tax at the end of there was 940. And then we need to go to where we have current liabilities. Just below that, we will check whether we have current tax. And we have current tax at the start, 2485. At the end is 25 what? 30. So then I need to go to the income statement and I take the income tax for the current year from the income statement. From the income statement, the income tax expense for the current year, I hope you can see that. From the income statement is 1,400. Is 14 what? 1,400 from the income statement. Then we also know that there was a subsidiary acquired, subsidiary disposed. Subsidiary acquired, we have that information in note number 2. So from where we are given its assets and liabilities, can we check whether it had a tax liability? The subsidiary which was acquired. Yes, and that subsidiary which was acquired as per note number 2, it had a current tax of 250. That is a tax liability for the subsidiary acquired. What about the subsidiary which was disposed? In note number 3, the last paragraph of note 3. The subsidiary which was acquired, was it having any tax liability? Yes, it was having no. The subsidiary acquired, I think we don't have any tax liability because we have account received. Yes, that subsidiary was not having any tax liability. So we balance our account. The balancing figure here basically represents the tax which was paid. You basically add everything, including the balances minus what we have on the debit. Yes, so the tax which was paid here is 13 what? 15. So tax paid is a cash outflow. Yes, next, let's determine this one, the interest or the finance cost paid. So for the interest, this one is quite straightforward. You just check 2 items. One, you go to the consolidated statement of financial position. Under the current liabilities, you check whether there is any interest accrued. Do we have any accrued interest or interest payable under the current liabilities? No. If that is the case, then the interest or the finance cost which was paid is the interest or the finance cost we have in the income statement. And I hope you can be able to remember that figure. We have it somewhere here, which is 220. So that is basically the interest or the finance cost which was paid. And I think we have considered all, there is nothing which is missing here. So mean that we can be able to proceed and we determine the net cash flows from operating activities. So let's determine that the net cash flow from operating activities. We work out all this. And I hope that is the figure I'm given by Gilbert here. 6175. I hope if you work out all that, it should give us this. Is that the figure you're getting? Is that the figure you're getting? Let's try to hurry up. We must finish this question. There is no way we are going to leave it hanging. And I can see we have 10 minutes. Yes, that is confirmed by Diana. So I think let's now move here. So cash flow from investing. What do we consider here? Assets which were acquired and the assets which were disposed. So I think we have most of the items here. Maybe starting from the additional information number 1. In the additional information number 1, we have this item of plant which was disposed. We will say there was a disposal of a plant, and basically what we consider here are the proceeds. So how much cash was received? This one, and which is basically a cash what? The cash inflow. So then from there, note number 2, we have this subsidiary which was acquired. What do we consider here? The net cash outflow. The subsidiary acquired. The subsidiary acquired, what we consider here is this one, 89, the net cash outflow. In note number 3, we have the subsidiary which was disposed. What do we consider? The net cash inflow. The net cash inflow is this one, subsidiary which was disposed. We consider the net cash inflow of what? Of 5,000. So I think we are done with the note 1, 2, 3. Note 1, 2, 3. Yes. So there is something also I said we consider here, and that are the dividends. received from associate. So this one is quite straightforward. We said you can prepare an account which is called the investment in associate, but no need of doing that. No need of preparing a ledger account. You can just compute this directly. So what you do, we go to where we have non-current asset. Can you go to where we have non-current assets? Under the non-current asset, we have the investment in associate. That is basically what we use in computing the dividends received from associate. So to compute this, we take the investment in associate at the start. The investment in associate at the start is this one. That is 375. And basically, it is the same thing. Even if you prepare the ledger account, because I've shown you how to prepare that ledger account investment in associate, you will get the same value. Investment in associate at the start plus the share of profit from associate. Can you be able to remember the profit from associate in the income statement? We have that figure here, this one. We add 720 minus the investment in associate at the end, which we still have under the non-current asset. That is 3875. So that's basically how we compute the dividends received from who? Associate. The dividends received from associate. Dividends received from associate, yes, to 20. And basically that is a cash inflow. There is something else here we must prepare, and that is the PP account. And this also, actually, where do we prepare the PP account? We prepare the PP account basically to determine, well, there are some items of PP which were acquired. So no need of basically preparing the PP account, but you're working here because so what we want to determine here is, well, there are some items of PP which were acquired. Mostly there will be some asset of PP which were acquired. The examiner will not give you that. So to determine whether there are PP which were acquired, no need of basically preparing a T account, but basically we can start with the PP at the start. And then you add what increases the value of PP. What increases the value of PP? One is any revaluation gain. Number two are the PP of the subsidiary which were acquired. Number three are the PP which were acquired in cash. Acquisition of a PP. And basically this is now what I want us to compute. And then you less those items which reduces the value of PP, like the disposal. And for the PP which were disposed, we consider them here at the carrying amount, or basically the net book value. We also deduct the PP of the subsidiary which was disposed. And then we will be able to get the PP at the end of the year. At the end of the year. Remember, in our case, we have all these items. So only one item which is missing, this one, PP which were acquired. So let's record these values here. We can go to where we have the non-current asset. We take the PP at the start and the PP at the end. The PP at the start had a value of 10,150. The PP at the end had a value of 15,900. That is basically what we have. PP at the start, PP at the end. Then we also have revaluation gain, this one. Revaluation gain, we have it in note number 1, paragraph 2. So there were some items of PP which were revalued upward, and there was a revaluation gain of 1,400. That increases the PP at the start. And then we add the PP of the subsidiary acquired. We know there was a subsidiary acquired in note number 2. That subsidiary had, or its PP had a value of 8,000. So then we come here and we list, was there an item of PP which was disposed? Yes. In note number 1, there was an item of PP which was disposed and its carrying amount was 1,560. In note number 3, the last paragraph, this subsidiary which was disposed had a PP which had a value of 45 30. So what we need to do basically is we get this balancing figure. We get that balancing figure which automatically represent the PP which were acquired. PP which were acquired. So let's work out that. So you have 10,150 plus 1,400 plus 8,000 minus 1,560 minus 4,530. Automatically, that will not give us this. So what is the difference between all what you're getting here? I'm getting 13,460 and basically this. What is the difference? 5,900. I'm getting a difference here of 2,440. So these 2,440, these are items of PP which were acquired. That is something the examiner will not give you. You have to compute that. So the PP which were acquired, they had a value of 2,240, and basically that is a cash outflow. That is a cash what? Outflow. I think we are basically done here. Nothing else to be considered here. Can we get the net amount? We take it to the last column. Let's get the net amount. We take it to the last column here. 1,720 minus 89 plus 5,000 plus 220 minus 2,240. Yes, so basically I'm given a net cash outflow of 4,200. Finally, we determine the cash flow from financing activities. Remember here, all the items which we get here, we get them from equity and the non-current liability section. So equity, non-current liability what? Section. Richmond, you're getting 44. So someone to confirm, I'm getting 42, a net cash outflow 42. So someone to confirm what you're getting here. Yes. So can we go to, we finalize on this? We finalize on this. You're getting 44? Ismail is equally getting 44. Is it an inflow or outflow? You must indicate whether this is an inflow or outflow. Okay. So can you confirm what you're getting outside? Oh, sorry. Yes, this is the figure which is basically long. Yes, so therefore this one should be correct. That one should be correct. That one should be correct. Okay. So let's finalize with this. So we go to the equity section in our consolidated statement of financial position. So what do we have at the equity section? So at the equity section, I have ordinary share capital. Do we have any change in the share capital? Yes. So the share capital has increased. What causes the share capital to increase? Is because there were some shares which were issued. So the increase is 2,000. So these are shares which were issued by the parent, which is a cash inflow. We also do the same for the share premium. So we have increase in the share premium. What causes the share premium to increase? Is because the shares which were issued at a premium, and the increase is 300, which also represent cash inflow. Below that, we have revaluation surplus. We don't consider that here because that is a non-cash item. That changes as a result of the revaluation gain. We don't consider that here. Then below that, we have retained earnings. The retained earnings, this one, is used to compute, we use that to compute the dividend which were paid by who? The parent company. How do we compute the dividends which were paid by the parent company? So to compute the dividends paid by the parent company, I can give you a formula for that. Paid by the parent company, we take the retained earnings at the start, and then to this we add the profit for the year, which is attributable to the parent company only. Attributable to the parent company, and then we less the retained earnings at the end. Are we together? That is the formula we use. The retained earnings at the start, profit after tax attributable to the parent company, minus the retained earnings at the end. That is the formula I want us to use here. So this one would be equal to the retained earnings at the start, basically which we have there, a figure of 6780, and then the profit after tax attributable to the parent. So this one you get it from the income statement. Below where we have other comprehensive income. So below other comprehensive income is given the total comprehensive income. And then down here, we are given the profit for the year. The profit for the year is the same with the profit after tax. What we are interested with is the profit for the year attributable to the parent company or attributable to the group owners. That is what you're interested with. That is the figure which you're given here over 4690. Sasa, yes. So that's what we consider here, the profit after tax attributable to the parent, and then we less the retained earnings at the end. That one is still at the equity, and that is 10,090. So this basically how we compute the dividends which were paid by the parent. The dividends which were paid by the parent. So the dividends which were paid by the parent, basically I'm given that by Gilbert as 1380, sorry, 1380. Is that what you're getting? Yes, 1380. So then below that, what do we have? Below that, we have the total equity, and then below that, we have something called the NCI. Now, the NCI, basically, we use that to compute the dividends which were paid to the NCI. Dividends paid to who? To NCI, to minority shareholders. For us to do this, we have to prepare an account which is called NCI account. NCI what? Account. NCI account. So the NCI account, how do we prepare this? We start by recording the NCI at the start. On the credit side, the NCI at the end of the year, that is something which you're given. On this side, we record the NCI share of the net asset in the subsidiary account. Or basically what we record here is the NCI at fair value for the subsidiary which was acquired. For the subsidiary which was acquired. On this side, we have the subsidiary which was disposed. The NCI share of the net asset in the subsidiary which was disposed. And also we record the NCI goodwill for the subsidiary which was disposed. So the balancing figure, which will be on this side, are the dividends which were paid to NCI. So can we record the NCI at the start, the NCI at the end? So this is actually one of the items in this particular question for group account, which is involves some working. So the NCI at the start, I can see that as 2000. As 2000. The NCI at the end is 1940. And then we go to note number 2. In note number 2, where subsidiary was acquired, SIBA. So what is the NCI at fair value on the date of acquisition? In note number 2, paragraph 2, the NCI was measured at 21.25. That subsidiary which was acquired, the NCI share of net asset was, or basically the minority shareholders invested an amount of 21.25. Yes, that's basically what we record here. Then what we do, we go to note number 3. Note number 3, the subsidiary which was disposed, the minority shareholders, remember that subsidiary had net assets which had a value of 61. So out of this, the parent company is entitled to 80% of the net asset because the parent company had acquired 80% shareholding. So meaning that the NCI were entitled to a share of net asset equal to 20%. So what will be 20% of this? 20% of this. 20% of that is what? Is 12.20. So NCI were entitled to share net asset equal to 12.20. Equally, if you can be able to recall this particular goodwill which we computed in relation to that subsidiary, that is Kifaru. This goodwill which we computed here is the goodwill of the parents, the goodwill of NCI. So what we need to do is we compute the goodwill of the NCI. Out of this goodwill, how much goodwill is the goodwill of the parent? So basically in this case, we don't take 80% and 20%, no. So what we do to compute the goodwill of NCI, take the purchase consideration paid by the NCI. Purchase consideration paid by NCI is basically what we have here, because this is the part purchase consideration paid by the parent, purchase consideration paid by NCI. Purchase consideration paid by NCI 2000 less the share of net asset at the date of acquisition. the share of net assets at the date of acquisition would be 20% of the net asset at the date of acquisition, which was 46. So that is basically how we compute the NCI goodwill, the NCI goodwill. So what will be the NCI goodwill here? The NCI goodwill. NCA goodwill. NCA goodwill, you're getting what? 1080? 1080, is that what you're getting? Yes. Yes. So basically, we also need to eliminate it because it was part of this 1080. So then we get the balancing figure here. That is the dividends which were paid. So let's wind up with this because I can see our time is over and we have even consumed 10 minutes for the next for the other class. So let's wind up on this. So what is the balancing figure in that account? Hmm? We're getting a balancing figure of what? It should be on this side. No, that one should be wrong. That one should be wrong. That one should be wrong because it should be on this side. If it is paid, it should be credited in the bank. 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 I think this one is correct. And I hope our opening balances are okay. Our opening balances okay? The opening balance is 2000. The closing 1940. NCI at fair value for the subsidiary which was acquired in note number 2125, the subsidiary which was disposed. Okay. So can we first of all skip this one because of time? So basically we should get now the net amount. Let's first of all skip that one. And then basically we should proceed and basically we add our three cash flows. This one, and this one. So and then we get something called the net changes in cash at the start. And basically this one we have it. So can we go to where we have current assets? So at the current assets, so we have the cash and cash equivalent at the start. The cash and cash equivalent at the start is basically 875. And then we have something called the cash and cash equivalent balance carried what? Down. And basically the cash and cash equivalent at the end of the year, which is 13 what? 1310. So I think basically I think we only have this one item which is missing. I'll be able to check why we are getting a negative figure here. It should be on this side. The dividend paid to the NCI should be on that side. So I think that is the only item which is missing. I'll be able to check why we have that figure coming to 115. I'll be able to check and then maybe I'll let you know. Sasa, yes. But because our time I can see is over, let's just stop at that point. We will be able to maybe see whether we will do another question in relation to this once we meet in our next session. But let's stop at that point for now. So have a good night. Let's continue from there in our next class. Do you have the question with you? If yes, please confirm. Please confirm, please confirm. I can see we have 1 hour, 20 minutes. We must finish this particular question here. We must finish that question. Okay, so what are we told? What are we told? That is the question number 2. So the question is, 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in Paper Limited, another public limited entity, on 1st of April 2024. So then we are told that the acquisition consideration comprised of an immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 1,331 million deferred until 1st of April 2026. This is what we refer to as the deferred consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. 𝐿𝐿 Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, 𝐿𝐿 Limited, together with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of 𝐶𝐶𝑠 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for 3 companies, 𝐿𝐿, Paper, and 𝐶𝐶𝑠. We have the statement of financial position for the 3 companies, that is 𝐿𝐿, Paper, and 𝐶𝐶𝑠. And then we have some additional information. This was actually one of the simplest questions, which has been tested in advanced level for group account. So we're given additional information. You can see actually the additional information, we're just given like 4 additional information. Then what are we required to do? Part A, we're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. To come up with a group structure. That's the first thing you always need to have in any question for group accounts. The group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in a company which is called Paper, a public limited company, on 1st April 2024. So the company which is called 𝐿𝐿 Limited, this company acquired 80% equity shareholding in a company which is called Paper Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐿𝐿 is the parent, and then Paper is the subsidiary. You can see also we're given the date of acquisition. Then from there, once we go to the paragraph number 3, let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐿𝐿 Limited, our parent company, with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of what? Of 𝐶𝐶𝑠 for an immediate cash payment of 15. So this company here, we are told, acquired 50% shareholding in a company which is called 𝐶𝐶𝑠 Limited. 𝐶𝐶𝑠 Limited, on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one will be a joint what? A joint venture. So that is the first thing you always need to have because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirement, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of a financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐓𝐿 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition. At the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary. Paper Limited net asset approximated their carrying amount with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of CSAT. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. Revalued the asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually, we said once the subsidiary company revalue the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby you have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which you are saying is the fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by Paper Limited. By Paper Limited. So we need to make 2 adjustments as far as this is concerned. The first one is called the revaluation adjustment. And basically, this is the adjustment in relation to the revaluation gain or loss. But remember, you said in most of the questions for group account, you'll come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of Paper Limited net asset approximated the carrying amount with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value with an amount of 560 million. So because this revaluation, okay, this 561, we are saying this is a revaluation gain. This is a revaluation gain by Paper. Did the Paper Limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PPE. And number 2, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we said in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation other charge. Depreciation other charge. And equally this depreciation other charge will be by paper, is by paper limited. So you need to recall the formula. There is a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, and then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Was acquired exactly at the start of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what year? We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here, 560 million. We are applying this formula. We divide that with the remaining useful price. And I hope you can see that within note 1. Can you see the remaining useful price? How many years? In note 1, remaining useful price. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful price of that asset. Can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here. We had 6 months. So then the proportion of time here is always 6 over 12. If we had, for example, 2 years, we're interested in the depreciation other charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation other charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now, this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PPE. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation other charge should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the office equipment is an administrative expense. Are we going to add this to the cost of sales? No. No. So in this case, we will add this depreciation other charge to what? To the administrative expenses. To the administrative what? Expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand, because in all questions for group account, you will come across this particular concept that the subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2, the revaluation gain and the depreciation other charge. Let's move to point number 2, where we are told LOC Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained, that if you come across that information, that it is a policy of the group, it is a policy of the parent company to measure NCI at fair value, That information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? The goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, which method are we going to use? Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. The full goodwill what method? That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCI fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to Rock Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to Rock, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by Paper to Rock, they had a value of 500 million. So basically we have said that these sales between the parent and the subsidiaries are fixed sales. So therefore this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number 2, we will also deduct this from the group cost of sales. Group revenue and also group cost of what? Of sales. So then in the same point, we are told half of these goods were still held by Rock Limited as at the end of the year, and the balance payable was still outstanding, and the balance payable was still what? Outstanding. Now, in that case, we have 2 adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us, first of all, we deal with we compute the amount of unreleased profit, So unrealized profit on inventory. Remember, unrealized profit, we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to Lock, but basically some of the goods remained in the inventory of Lock. They were not yet sold to third parties. We need to compute the unreleased profit, and this unreleased profit is always by the selling company. The selling company is this one. So this is unreleased profit by Paper. So how do we compute this unreleased profit? We take the unsold goods times the gross profit margin. Times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unrealized profit basically by applying this formula here. We will take the unsold goods. And in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Rock. The unsold goods will be half of the goods which were sold by Paper to Rock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question, we are given the gross profit markup. Gross profit markup is 25%, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20% as a fraction. As a fraction, it will be equal to what? As a fraction. As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1 over 5. So this one will be, the margin will be 1 over 5. So how much will be our unreleased profit here? So it will be half to 50, and basically that will be 50 million. So this unreleased profit number 1, this will be deducted from the group inventory. In preparing a consolidated balance sheet, we let's start from the group revenue. Number 2, this one will also be deducted from the retained earnings of the selling company. The selling company is paper. That one will be deducted from the retained earnings of paper. And then in preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. To the group cost of sales. Those are the 3 adjustments which will be made as far as that and his profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that, that point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable, was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here will be 500,000, 500 million, that is, because the amount of money which Lock Limited was supposed to pay paper was 500 million. So this amount is the one which amount to, or which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. Group receivables and group what? Payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically revealed that both goodwill on acquisition and on paper limited and the interest in sisters were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no working which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that information is always given such that if there is something you need to apportion on time basis, or something you need to apportion, you apportion it on time basis. You apportion it on time what? Basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition, because there is something we will compute there. Let's first of all, we compute the goodwill on acquisition of this company here. Remember, you said we only compute the goodwill on acquisition of the subsidiary, and we recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill. The goodwill on acquisition of this company, that is paper, paper limited, and as per the information we have in note number 2, we are using the full goodwill method. The full goodwill method. So here we need to have two columns, and our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2. Paragraph 1 and 2. Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was in two forms: the cash consideration, and I hope you can be able to recall, we say that this one do not have any special treatment. That amount we are going to use it as 2,400 million. So an immediate cash payment of 24. And this one, if you go to the balance sheet or the statement of financial position of the parent, and as a non-current asset, you should be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that point number, paragraph 2, we are told an immediate cash payment of 24 and on 1st April 2024, and a further consideration of that 1331 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and lock limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take 1331 and basically we discount this to the present value by multiplying that with the present value interest factor at the rate of 10%. And basically for how many years? How many years do we have from the date of acquisition? 1st of April 2024. This is the date of acquisition. That consideration will be paid on 1st of April 2026. How many years do we have here? How many years do we have there? Yes, we have 2. We have the first year which will end first, or basically 1st April 2025, 1, 2. So for 2 years. So this one will be computed like this. We take 1. Remember the formula here. 1.1 raised to power negative 2. Yes, basically that's how we discount this. 1.1 raised to power negative 2, raised to power negative 2, raised to power negative 2. That's basically how we are going to discount that. Times 1331. And basically that one is coming to 1100. Is that what you're getting? 1100? 1100. 1100. 1100. Is that what you're getting? Diana, is that what you're getting? Georgina, is that what you're getting? Is that what you're getting? Yes. Okay, so then this is basically the purchase consideration paid by the parent. And then now to this, what do we need to do? We need to add the NCI at fair value. Remember, you're using the full goodwill method. The NCI at fair value, this one is given in note number 2. Is given in note 2. So the NCI at fair value is 860. 860. So we need to add those 3 values so that then we proceed and we less the net assets, which one? Acquired. And basically, I'm told that this one will give us 4360. 4360. Okay. So then to this, what do we need to do? To this, we need to proceed and we less the fair value of net assets which were acquired. So remember, you say that this is one of the items which the examiner will not have given you, and this whereby majority of the students have a challenge. How do we compute this? We say to compute this, we take the ordinary share capital of the subsidiary plus pre-acquisition reserves. plus pre-acquisition reserve. So what we do, we have to go to the balance sheet of the subsidiary, specifically at the equity. Can we go to the balance sheet of the subsidiary? Subsidiary is paper, specifically at the equity. At the equity, we start by taking its ordinary share capital. Its ordinary share capital was, or is basically 2,000. Below that, what do we have? We have share premium. In this case, if you're given a share premium in the balance sheet of the subsidiary, and the question is silent, the question is what? Silent. We always treat that as a pre-acquisition. We always treat it as what? As a pre-acquisition. And then from there, we have the retained earnings. The retained earnings. But basically what we know is that retained earnings which we have there, that is the retained earnings at the end of the year. So what we are interested with here is the retained earnings on the date of acquisition, because this is a reserve. This is a reserve. We're interested with the retained earnings on the date of acquisition. And basically what we know, I've said that the retained earnings which are given there of 1,800, this is the retained earnings at the end of the year, 31st of March 2025. So we are interested with the retained earnings of paper on the date of acquisition here, 1st of April 2024. How do we get that? Very simple. Because one, we know the retained earnings of this company for the current year. In other terms, what is the profit after tax of paper? So the retained or the profit after tax of this company during the current year. So you get that from the income statement. Can we go to the income statement of paper? The income statement of paper, you tell me how much was its profit for the current year. How much is the profit after tax for the current year for paper? Can you see that amount? It is 520. It is 520. So how do we arrive at this value here, the retained earnings at the end? To arrive at this, we take the retained earnings at the start, which we don't have. We add this, we get this. Sasa, we take this plus this, we get this. What we are interested with is the retained earnings of this date. So can we be able to get this? Take into account to get this, we take this plus this, we get this. It's very simple. So to get this one, we will take this minus this, we get that. So therefore, the retained earnings at the start will be 1,800 minus 520. And this will give us 12 what? That will give us 1280. 1280. So 1280 is basically the retained earnings on the date of acquisition. And therefore, if you check there, we don't have any other reserve. But in all this particular question for group account, there is something you must always remember to check. Did the subsidiary company revalue the asset on the date of acquisition? If yes, was there a revaluation gain? Remember here, Paper Limited revalued the asset. There was a revaluation gain of 560, which we said is a pre-acquisition revaluation reserve. So we have a pre-acquisition revaluation reserve of what? Of 560. Yes, we don't have anything else. Let's get this total. Let's get this total. This will give us a total of what? This will give us a total of 40. So because you're using the full goodwill method, we take 100% of that. When using the full goodwill method, take 100% of this. We are interested with the net asset acquired by the parent and the NCI. Parent and the NCI. So this will give us 40. So we less it from the figure we have up there, and basically we get the goodwill. We get the goodwill. So our goodwill will be what? Will be 320. Now, also you have to check, was this goodwill impaired? In our case, we are told as per the information we have in note number 4, the goodwill was not impaired. So I think having this now, I want us now we prepare what we are required. And because we have now the workings, all the workings, basically to prepare what is required should not take us a lot of time. So we go straight to part A, the consolidated statement of profit or loss. Let me just have that here. The consolidated statement of profit or loss, which is for the year, which ended 31st of March 2025. 31st of March 2025. Yes, so here we just need to have a single column, and basically we indicate that our figures are in million of shillings. So how do we prepare this? As per our group structure, we are basically combining the revenue and expenses of the parent, those of the subsidiary. We combine the revenue and expenses of the two companies. It is also important to note that this company, taking into account it was acquired exactly the start of the year, we will take the revenue and expenses of paper for the whole year. For the whole year, we combine with that of the parent. In our case, remember, we don't consolidate a joint venture. Instead, what we will compute is the parent company share of the profit after tax, and basically we recognize it what here. So let's do that now. So how to prepare this, we go to the statement of profit or loss for individual companies, which is basically given below paragraph 2. And we use the format which are given here. So we will start with the revenue. We take that of the parent, 520, plus that of the subsidiary, which is paper, 80. So remember, we are not consolidating their joint venture. So and then to this, what do we need to do? We need to less any sales between the parent and the subsidiary. And I hope you can remember you have this intra-group trading of 500 million. We less it here. No any other adjustment. No any other adjustment. We get the final value. We try to hurry up so that we finish. Although I can see we have time. We have time. So once you get the answer, type it in the chat box. I'll be able to see it. So I'm told that will give us 13,200. 13,200. Someone else to confirm. Is it 13,200? Is it 13,200? Is it 13,200? Yes. So then below that, we take the cost of sales. We do the same. 5510 plus 3440. So to this, we have a number of adjustments to be made. One, we less this amount of intra-group trading, 500. So we also have this depreciation. Okay, this one will not be adjusted to the cost of sales, but rather to the administrative. We have this and this profit of 50 to be added there. And I don't think we have any other adjustment. So we get the final value there. The final value. Final value, I'm given 85. I'm given 85. Okay. So we move and basically we compute the gross profit. So the gross profit here will be how much? How much will be our gross profit? The gross profit will be 47. So then to that we proceed and basically we add the distribution. I think before we add the distribution, we can do this. We need to compute the group share. The group share of Sisters Limited profit after tax. Remember, this is basically a joint venture. That's what we include here as far as the joint venture is concerned. So what we need to do, can we go to the income statement, the statement of profit or loss of Sisters, and you give me its profit for the year or the profit after tax. The profit after tax for Sisters is how much? Is it 640 million? Yes, 640. Now, then we need to determine when was our joint venture acquired. You can see the date when it was acquired, this date here. 1st of October 2024. This is within the current year. The current year is added, the current year ended on 31st of March 2025. How many months do we have here? Are they 6? So we have October, November, December, January, February, March. 1, 2, 3, 4, 5, 6. So in this case, we have how many months? Yeah, are they 6? Are they 6 months? Do we have 6 months? I've said 1st of October 2024. So our joint venture was acquired 6 months to the end of the year. So the parent company will only be entitled to share profit from the date it acquired that joint venture. It will only be entitled to share profit for how many months? 6. That's why we have to compute profit of 6 months, and then we multiply that with the parent company shareholding in CSAS, which is 50%. That gives us now the group share of CSAS limited profit after tax. You think this one should be 160. This one should be 160. And then from there, let's proceed with the expenses. The first expense we have there is the distribution cost. And I hope you can be able to recall that if you come across these always are 3 mark. No single question for group accounts will come across whereby the distribution cost is to be adjusted. These always are 3 mark. We take 830, that of the parent, plus that of the subsidiary. No adjustment. We get the total, which will be 1,300. Which will be 1,300. Are you getting that here? Yes. So then below that, we have the administrative expenses. Administrative expenses, we check that of the parent, 860, plus that of the subsidiary, 520. And then to this one, we have to add this depreciation under charge of 70 over 70. Also, in case our goodwill was impaired, in case this goodwill was impaired, any impairment loss for the current year, we also include it within administrative expenses, but we don't have any impairment loss. We get the final figure, which will be what? Which I'm told is 1450. 1450. Is it 1450? Yes. So then below that, we don't have any other expense. Okay, there is something we will include here. That one, you have to be very, very keen to remember that. Because I hope you can be able to remember, we have this deferred consideration. You see this deferred consideration, basically this represents what the parent company will have to pay at the end of the second year. So therefore, once we have discounted this deferred consideration to its present value, we have to amortize it. In the process of amortizing a liability, there is something which arises, which is known as interest. If you're amortizing a loan, if you're amortizing even, for example, financial liability, there is something which is known as what? Interest. So that interest is basically recognized here as part of the finance cost. So the finance cost will basically be the interest on this deferred consideration. How do we compute that interest on the deferred consideration? On the deferred consideration, we take this amount which you computed here, the present value of the deferred consideration. And for us to be able to compute the amount to be recognized as an interest during the current year, we multiply this with the rate which you have used to discount, which is 10%. 10%. So this will give us 110. Now this 110 is the interest on deferred consideration. Interest on deferred what? Consideration. And then this interest basically should increase the value for this. So what I'm trying to avoid here is basically to prepare a amortization schedule, but I think I can do that very fast so that you understand. Amortization schedule. We are saying we should amortize this. You see, this is the deferred consideration at the start. This is like our own amortization schedule. You have a column for years, the liability at the start, the interest, the cash paid, and the liability at the end. No need of doing that because we know what we want to do. We want to compute the interest, which will be 10%. And then, is there any cash paid during the current year? No, no cash paid. So therefore, to compute the liability at the end of the first year, we take this plus this. Can you add for me that? So that you understand what we amortize this. So that will give us 1210. So in fact, when preparing our balance sheet, this is the value of our deferred consideration. The deferred consideration is a non-current liability, and that is its value at the end of the year. Then that would be the opening balance in the next year. And then we compute the interest, which is 10% of this. We did come to 121. Is that what you're getting? Yes. Now we know the deferred consideration, this one, will be paid at the end of the second year. So at the end of the second year, the company will pay 1331. And once you do that, then you should get 0 there. You should be able to get 0. Will you get 0? Yes. Are you getting 0? Yes. So this is how we amortize that word. That. So basically, in relation to this deferred consideration, 2 items. One, this interest is part of the finance cost here, which is 10% of 1100. And then when preparing our consolidated statement of financial position, this one will be recognized as a non-current liability. Sasa, yes. So having that, then we can proceed and we compute the profit before tax. Give me the profit before tax now. The profit before tax down here. How much would be a profit before tax? This plus this minus the 3 expenses there. I'm told this one will be 2,000. I'm told that one will be 2,000. Will be 2,000. Then we list the other item, which is also always a free mark. Income tax expense. Income tax expense, also this one, is always a free mark. A free mark. So no question for group account whereby income tax will be having adjustment. You take that of the parent and that of the subsidiary. And this will give us what? This will give us 670. 670. And basically we get what? We get profit for the year. Profit for the year, which will be 680. Which will give us which will give us what? 1320. Yes. So basically in our case we are done, and that's what was required. The marks allocated there were 10. So this basically what was to give you what? 10 marks. You can see in that question, it basically means that for any correct item which you had here, basically should be 5 marks, because these 6 cannot be 10. Yes. So having that, let's move to part B. The consolidated statement of financial position. Consolidated statement of financial position is at 31st of March 2025. Okay, so we prepare this one. We just need to have a single column here. And what is basically important for you to remember is that here, or this one is basically prepared by just combining similar items of assets and liabilities, those of the parent and those of the subsidiary only. As far as the associate is concerned, CSAS, we will include something called the investment in associate. So let's prepare this one. We start with the non-current assets. So for the non-current asset, we will start with the PPE, the property, plant, and equipment. So, and basically we take that of the parent 4260 plus 3660. And then you have to recall, we have an adjustment to be made to the PPE in relation to this working. So we said this 560 will be added to the group PPE, and then this depreciation other charge of 70 will be deducted from the PPE. 2 adjustments here. 2 adjustments, we add the revaluation gain of 560, we less the depreciation other charge of 70. We get the final value there. The final value will be what? What will be the final value? The final value, I'm told by Gilbert, will be 8380. 8380. That is the same figure I'm getting from Diana. So then from there, below that, we have investment in paper, investment in scissors. Remember, these are the purchase considerations which were paid by the parent company in acquiring shares of scissors and paper. Do you include that here? No. In relation to the subsidiary, which is paper, what we include here is the goodwill. We include the goodwill on acquisition of the subsidiary, which is paper limited. And basically that's what we computed here, 320. 320. In relation to scissors, which is the joint venture, we compute something called the investment. The investment in joint venture, or basically joint arrangement. I just refer to it as the joint what? The joint arrangement. And basically we recognize that here is an item of what? As an item of non-current asset. I want us to have the working here, because I remember I've given you the format for computing this. How do we compute the investment in associate or joint venture? I said one, you take the purchase consideration which was paid or the cost of investment. That is basically what we have within the statement of financial or within the statement of financial position of the parent under the non-current asset. How much purchase consideration was paid by the parent company in acquiring the shares of the joint venture? That is 15. That is 15. And then to this we have said we add what? To this we have said we add the group share of the joint venture post-acquisition retained earnings. And basically take into account our joint venture was acquired during the current year, Sisters was acquired during the current year. The amount which we include here, which we have included here, that is now the same with the group share of the post-acquisition retained earnings of the associate. That is basically what we will add here, 160, this one. And then to this we less any impairment loss. And I hope you can be able to recall in note number 4, we were told that in note number 4, you are told the goodwill on acquisition, the investment in associate had not impaired. They were unimpaired. So we don't have any impairment loss. And that will give us what? 1660. That will give us 1660. So that basically what we include there. Then from there we proceed and basically we record the current assets. So for the current asset, we are given the total. We will take that is 720. That is of the parent plus that of the subsidiary, 2270. And then in this case, you have to recall that inventory, receivables, cash, and bank balance are part of this. Any adjustment affecting this inventory and receivables should be made here. And I think you can be able to recall here, we have this and this profit, which we say should be deducted from the group inventory. Inventory is part of this. So we less unrealized profit of 50. And also we have the amount of intercompany debt, this one, of 500. We also less it here. I don't think we have any other adjustment. So let's get the final figure. We get the final figure. I don't think we have any other adjustments. So what is the final figure here? I'm given 50, 440, 5440, 5440. Yes. So then what will be our total? What will be our total assets? What will be our total assets? You add all this, you give me the total assets. And because of space, I want to do away with this one. I want to do away with this one. Yes, the total asset in our case will be 15,800. I want to do away with this now. Yes. So then from this, we need to move. And basically, we record equity. So for the equity, we will start with the ordinary share capital. Ordinary share capital. And I hope you can be able to recall the ordinary share capital. We don't consolidate this. We only include the ordinary share capital, that of the parent company only. The ordinary share capital of the parent company only, which is how much? Which is 5,000. 5,000. Below that, what do we have? We have share premium. Equally, the share premium, we basically include that of the parent company only. That of the parent company only, which is 500. So below that, we have what? We have the retained earnings. So basically, retained earnings is one of the items which is a little bit tricky in terms of its computation. Maybe first of all, we can skip this one. We will come back and compute it. Then we will get what? We will get the total equity. We will get the total equity. And I hope you can also be able to recall your total in a fund. These are some of the items you don't have to compute in an exam. They will consume a lot of your time and you end up maybe getting that figure wrong. So, but we will come back and compute. We will compute that. Then down here, after getting this, we also come and we compute something called the non-controlling interest. I'll be able to explain what is this in the process of computing that, but we will compute this as the last two items. Then from there, we need to proceed and we record liabilities. I think for liabilities, we have the current liabilities, but in this case, there is something we are going to introduce. We are going to introduce non-current liabilities. I hope you can be able to remember this deferred consideration. These are consideration to be paid by the parent company in future. So that deferred consideration will be recognized here as a non-current liability. And basically, I've said the value for deferred consideration at the end of the day is this one. We have amortized that. So this amount plus the interest for that year, which will give us what? Which will give us 2110. And then finally, we have the current liabilities. Current liabilities, we take those of the parent 3,000 plus 19, those of the subsidiary. And then you have now to record that these include payables. Payables, we have amount of intercompany debt, which should be adjusted from the payables, this one, 500. So that one should be deducted here, 500. So give me the final figure. Give me the final figure here. The final figure for payables, for current liabilities. For current liabilities, I'm told is what? 44. Yes, 44. 44. So what I want us to do, I want us to compute these two items here very fast. Very, very fast. We should be able to do that in the next 10 minutes. We should be done. Yes, so we can start by computing what? Let's start by computing the group retained earnings. But basically, I've said, if, for example, you're doing that question in an exam and basically you leave it like that, you should be able to get all marks. You should be able to get all the marks. So let's start by computing this one. The group retained earnings at the end of the year, that is carried down. That is carried down. That is carried down. So how do we compute this one? How do we compute this? So the first thing maybe you need to remember is the formula. How do we compute this? So this one is computed by taking the 100% of the parent company retained earnings plus for this company here, that is paper, we should take 80% of a post-acquisition retained earnings plus 50% of sisters. I've said 80% of paper, paper limited post-acquisition retained earnings plus 50% of sisters limited post-acquisition retained earnings. Yes. That's basically how we compute that. So what basically you should do is to have 3 columns for our companies here, starting with the parent, which is log, the subsidiary paper, and the joint venture sisters. And basically in this case, we will take what? We will take the retained earnings as given in the statement of financial position. So we go to the statement of financial position, we take the retained earnings balance carried down as given in the statement of financial position. So can you go to the statement of financial position of these 3 companies, specifically at the equity? At the equity, we are given the retained earnings of log, that 380. For paper, it is given as what? 1,800, and for sisters is given as what? Is given as 12. So the first thing we need to do for these 2 companies, we are interested with the post-acquisition. So what we need to do for these 2 companies is to less the pre-acquisition. What? Acquisition. That does not apply to the parent. It only applies to these 2 companies. Yes. And I think for this, what we will do, for this company, I think we computed we computed for paper, we computed the pre-acquisition. The pre-acquisition retained earnings, which we have used in the computation of goodwill. How much was it? Give me that figure. We have computed the pre-acquisition retained earnings for paper. That is something you've already computed. Who can give me that figure? That retained earnings in tulitumia ku compute goodwill ya paper. Was it 1280? The one at the start? Yes. So this one we said is pre-acquisition. Is that the case? So pre-acquisition here need 1280. So we will less it there such that we shall be left with the post-acquisition. And then what about the scissors? Scissors, when was it acquired? I hope you can remember when scissors was acquired. Scissors was acquired 6 months to the end of the year here. Was acquired 6 months to the end of the year. 6 months to the end of the year. Basically, for scissors, we need to have first of all its retained earnings at the end. Its retained earnings at the end for scissors is 12. The value which we have here. Let's be together here. And then we also need to have the profit for scissors for the year. That one we get it from the income statement. From the income statement, the profit for the year for scissors is 640. Silio? Yes. So can we first of all get the retained earnings here at the start of the year? So to get the retained earnings at the start, we will take this minus this, we get this. This minus this, we get this, which will give us what? Which will give us 560. So can we be able to get the retained earnings of scissors on this date of it was acquired? Just like how we computed this. It's quite simple. To touch this one at the start 560, and then we take for the whole year, which is 640. And here, because we have 6 months, we get half of this. We multiply that with 6 all over 12. So we take 560 plus 320 plus 320 plus 320. That will give us what? That will give us, I hope you can see what I've done. I've taken the retained earnings of scissors at the start, which you have said is this, minus this, which will give us 560. And then for me to compute its retained earnings on the date of acquisition, which is pre, I've taken the retained earnings at the start plus the profit for the year for this 6 months, just like what we did for the subsidiary. So, and I'm told that will give us 880. So now we get the post. Basically, I've said this does not apply to the parent. So what do we get here? Because of time and track value, what do we get here? We get what? 520. What about this one? We get 320. We get 320. Yes, 320. Then before now we apply these percentages, because this one we should take 100%, this one 80%, this one 50%. Some of the retained earnings here we need to be adjusted. As per the workings which you have done here, number one, we have this depreciation other charge, which we said should be deducted from the retained earnings of this company. So we have depreciation other charge to be deducted from the retained earnings of paper, which is 70 there. So this and this will not affect that, but we have this and today's profit, this one. We say this one will also be deducted from the retained earnings still of paper. So we have and today's profit that will also be deducted from the retained earnings of paper 50, like that. Do we have any other adjustment? I can't see any other. So we need to get the final figures. That is 380. This one 2400. This is 320. And then we get the group share of this. The group share. We apply now these percentages. This one for the parent we take 100. For paper we take 80. And for this company that is the sisters, we take 50. we take 50%. 50%. So this will be 160. This will be 320. This one will be 3380. And then we add these two. We add those three values. We add those three values. That will give us the group retained earnings. The group retained earnings. I'm told that will give us 38.60. Basically, you can see how the computation for this is quite demanding. And that's why I'm saying, for example, if you're doing this question in an exam, I will not advise you to do this. I will not advise you to compute this. Yes. So maybe first of all, you can get the total equity before computing NCI. So this will be 55 plus 3860, which basically will give us 9360. Finally, we compute the NCI. So the NCI is what? We'll talk about the NCI basically. This refers to the amount of money which is invested by the minority shareholders in the subsidiary. The capital invested by the minority shareholders in the subsidiary. Amount invested by the minority shareholders in the subsidiary. How do we compute the NCI at the year end? To be recognized there as a component of equity. Now to compute this, very simple. We take the NCI at fair value, and the NCI at fair value, which is basically given in note 2. The NCI at fair value in note 2. How much is the NCI at fair value? The NCI at fair value in note 2 is what? Is 860. 860. I hope you can see that. And then to this, what we add here is something called the NCI share. NCI share law, the post that is of the NCI share of adjusted post acquisition retained earnings in the subsidiary company. So the NCI share of the post, that is the NCI share of the adjusted post acquisition retained earnings in the subsidiary. So where do we have this figure? The adjusted post acquisition retained earnings of the subsidiary. So that is basically the figure which we have here. This is the adjusted, this is the adjusted post acquisition retained earnings of the subsidiary. Which is how much? 400 million. So we get the NCI share of that. The NCI share of this will be 20%. Will be 20%. 20% of that will give us what? That will give us what? That will give us what? Is it 80? Yes, it will give us 80. And then now to this, in case, for example, we had an impairment loss, the goodwill on acquisition was impaired. What we less here is the NCI share of impairment what? Loss. Was the goodwill impaired? No. No, it came to be a deducted share. So we add these two values and they give us 940. So the NCI fair value here is basically 940. But basically I'm saying although these are some of the tips we will be able to discuss in the during our revision. So whenever you're doing that question in an exam, I will not advise you to compute this and this. Because even without computing those two items, you'll have scored all the marks. Is our statement of financial position or balancing? It is not balancing. That is what I'm told. What is the difference? What have you omitted? Ten. Or 10 bob. $10 bob. 10 bob is, how do we have that? Where do we have that then, Bob? Yes, I think it is. That one should be. Is it interest? The interest on deferred consideration. No, that one is captured there. That one is captured there. That one is captured there. So you're saying the difference is the, what is the difference? Is the difference is it 110? 110? Yes, I know where that one should be captured. That one basically should be deducted from the retained earnings of the parent here. Because that is an interest or is basically an expense which the parent company was supposed to have accounted for. But if you check on the income statement, the parent company had not accounted for the interest on this. So that one should also be adjusted here. The interest on deferred consideration, it should be deducted from the retained earnings of the parent. Deduct that here. Deduct that here. It was supposed to be accounted for as an expense by the parent, but the parent company had not accounted for that in the income statement. Was it accounted for by the parent company? No. So that's why it should be deducted there. 33, 80 minus 110. So now this one should be 92, 70. And the retained earnings should be 30, 37, 50. Yes, it should now balance. It should now balance. It should now balance. Is it not balancing? Yes, it should balance. So I think that is what you have forgotten here, because remember, these are an expense which the parent company was supposed to have accounted for. It the parent company needed to recognize this as an expense, and that's why you can see in the income statement the parent company didn't have a finance cost that was supposed to be captured here, and therefore even the profit which you have taken into account here, that was supposed to have been deducted, and because it was not deducted, that's why we're deducting it here. Sasa, yes. So basically, this is what was required as far as that question is concerned. And I'm saying this is one of the easiest questions which has ever been tested in advanced financial reporting in relation to the group account, in relation to the group what? Account. And there is a question which I'll give you there as an assignment. You attempt it, because now what I want us to do once we meet in our next class, we are looking now on special cases in group account. We will start by looking on the aspect of piecemeal acquisition. We do a question, just a small discussion, and then we do a question. In our next class, that is what we will do. That is on Tuesday. Then on Wednesday, we will be able to look on how we account for the disposal of interest. And then on Saturday, we do foreign subsidiaries. So basically, we should be done with this next week. What we will be remaining with is the group cash flow. Is the group what? Cash flow. So because we have those three concepts which are remaining: piecemeal acquisition, the disposal of interest, and the foreign subsidiary. We will be able to take one class each, but basically we will be able to come back and look on this during our revision. So the question I want you to attempt is the question for December. The question for December 2022, which basically is question number 3. Question number 3. I want you to attempt this one. Maybe during our revision, we will be able to look on it. We will be able to look on that. We will be able to look on this. We will be able to look on this. Remember, what we said is that if everything goes on well, we should be done at least with this by next week, our first class. And then from there, I think what will be remaining is maybe the theories, and maybe like the financial statement of the insurance company. Right now, we can say that we are almost like over 85% done with the syllabus. So I'm hoping that if everything goes on well, we should be done with this by next week. But one on Tuesday, onward Tuesday. So let's stop at that point for today. You have a nice weekend and make sure you attempt that particular question. In case you come across any challenge, you can maybe get some assistance from me. Equally, if you're able to attempt the question, you can send it to me. I'll be able to check on it and give you the feedback. Sasa, yes, we stop at that point. Have a nice weekend. See you next week on Tuesday.
Good evening, class. Good evening, class. Thank you. Thank you, thank you, thank you. So we are the guys who have been blessed to be in class today. So we fold our sleeve and we start. So we fold our sleeve and then we start. So where did we stop? Where did we stop? So there was a last statement, made a number of statements, just a recap of those statements. That in case of, for example, I'm just reminding us of what we said. We say that when you look at water pumps, and generator, we basically say that under manufacturing, we basically grant them investment allowance at the rate of 50% in the first year, 25% on a straight line per annum. That is from the second year on the remaining balance. From the second year on the remaining balance. And lastly, we were saying that in case of, let's say, for example, in case of hire purchase, let's say you buy an asset, you buy what you call an asset on what you call hire purchase. If you buy an asset on hire purchase, the value that basically qualifies, we say that the value that basically qualifies, if you buy an asset on hire purchase, the value that qualifies for investment allowance is what's called the cash price. Cash price is what qualifies. We say qualifies for what you call for investment allowance. Cash price is what qualifies for investment allowance. We say ignore what you call the hire purchase. So what qualifies for investment allowance? It is the cash price. And we do what? We ignore what you call the hire purchase. It is the cash price that qualifies for investment allowance. We ignore what we call the hire purchase. Together, team. What qualifies for investment allowance in case of hire purchase? It is the cash price. So if an examiner brings a question and gives you the hire purchase and the cash price for a fixed asset, the value that definitely qualifies for what we call the investment allowance, we say is the cash price. Cash price is what qualifies for what we call investment allowance. Perfect. So then how do you get investment allowance? We say that investment allowance is equals to investment allowance or wear and tear. In case of wear and tear, we say that wear and tear rate, wear and tear rate, then you say times wear and tear rate into brackets, because initial value, we are not using written down value because nowadays they're basically on a straight line. Initial value, then you say plus additions minus what you call the disposals together. This is how we basically calculate what we call the investment allowance for wear and tear. So the wear and tear rate either is 25 or 10% times into bracket. We say the initial value plus what we call additions. These are assets that have been bought during the year. Then you less assets that have been basically disposed during the year together. Then you less the assets that have been disposed during the year. You give me a yes if you're together. You give me a yes if you're together. Perfect. Then say the following values. You say the following values we say are used. We say the following values are basically used as addition, we say during what we call the year. So the following values, we use them as addition during the year. The following values, we use them as addition during the year. One, we say to buy an asset, we say the purchase cost plus cost incurred, we say before the machine is put to use, plus the cost that is basically incurred before the machine is put to use. We say that the costs that are basically incurred before the machine is put to use, we have installation, i.e., we call it installation cost, installation. We have the taxes, what we call the taxes paid. We have the taxes paid, e.g., we have VAT and what we call the custom duties, etc. VAT and the custom duties, etc. We also have the transportation cost and executives. We also have the transportation cost and etc. So if you purchase an asset, that will be during the year, that will be the value of addition plus the costs that are incurred before the machine is put to use. I have talked about installation, taxes paid, like VAT and the custom duty, but you also have the transportation cost together. We also have the transportation cost together. We respond with a yes, if that is at home. We give it a yes if that is at home. So then we say the second scenario, say in case of a trade-in, what we call a trade-in situation, in case of what we call a trade-in situation, in case of what we call a trade-in situation, in case of a trade-in situation, the value of the new asset, we say that the value of what we call the new asset. So the value of the new asset, we say that the value of the new asset, brought in, we say qualify as addition. So in case of a trade-in, we basically say that the value of the new asset that is brought in qualifies to be what we call addition, qualifies to be addition together. The value of the new asset that is brought in, that is what is going to qualify as an addition. You give me a yes if you're together. Perfect. Then we say in case of hire purchase, in case, we just put in case of what we call hire purchase, in case of what we call the hire purchase, in case of the hire purchase transaction, in case of what we call the hire purchase transaction, in case of the hire purchase transaction, we say cash price, we say is used and we ignore what we call the hire purchase, and we basically ignore what we call the hire purchase. That in case of hire purchase, cash price is used, and we ignore the hire purchase. Then we lastly, as an NB, that is an addition, we say that for SUV and what we call saloon car, for SUVs and what we call the saloon car, for SUVs and what we call the saloon car, SUV, if the value, we say exceeds 3 million, if the value basically exceeds 3 million, we restrict, we say to 3 million. So when you buy an asset, and that is the addition. In case of SUV, those are sport utility vehicle, Mercedes-Benz, Land Cruiser, and saloon car. We're basically saying that if the value exceeds 3 million, we restrict to 3 million. We respond with a yes. We restrict to 3 million. Give me a yes if you're together. We basically restrict to 3 million. Perfect. So then the last part is on the disposal part. The last part is for disposal, we say the following qualifies, we say to be what we call the disposal, qualifies to be disposal value. That for disposal, the following qualifies to be disposal value. Number one, that will qualify to be disposal value, we call it sales proceed. We call it sales proceed of an asset. So the value that you get when you sell an asset altogether, the value that you get when you sell an asset, that will qualify as the disposal value. Together, team. That in case of disposal, the sales proceed, the value that the asset has been sold, qualifies to be the disposal value. Together. In case the sales proceed of an item. The number two is for an item stolen, for an item stolen, for an item that is stolen, or we say involved in an accident, for an item that is basically stolen or involved in an accident. We say insurance. We say that insurance compensation, we say qualifies to be what it qualifies to be the disposal value. Make sure those concepts are at the back of your mind. Let's say, for example, you had an asset, and you're saying that, for example, for an asset that is stolen or involved in an accident, the disposal value will be what you call the compensation. The insurance compensation qualifies to be the disposal value. For an asset that is stolen or was involved in an accident, the value that is compensated by the insurance company is what qualifies to be the disposal value. You give me a yes if we are together. That value qualifies to be what we call the disposal value. Perfect. Thank you so much. Then the last item before we get to the question. For saloon cars, then say for saloon cars and what we call the SUVs, for saloon cars and SUV, for saloon cars and SUV, if the value, we say, was restricted, if the value was basically restricted, if the value was restricted, if the value was restricted, when added, let's say, when added, we say disposal value, we say is determined as follows. So if you're disposing an asset that was basically restricted, an asset that was restricted during addition, are we together? So the disposal value should also be restricted. I am saying that if when you're adding an asset, the asset was restricted. It therefore goes that when you're disposing, the asset should also be restricted, So how do we get the disposal value in that case? So we say that the disposal value, i.e., we say disposal value, the disposal value should be what we call the sales proceed. That is just the SP, sales proceed. The disposal value should be the sales proceed over what we call the initial cost. Then you say times restricted value, which is 3 million. Are we together here, team? I want us to understand this. That if basically, we are saying that if basically you are disposing an asset that was restricted when you are adding it together. Therefore, it goes that when you're disposing also that asset, you need to restrict. How do we restrict? We say the sales proceed over what we call the initial cost, that is the buying price, then you multiply by 3 million. This will not qualify as what? As the disposal value, but you restrict. What you get is what you get as the disposal value, Tubonyeza yes, kama tuko sawa. Tubonyeza yes, kama tuko sawa. If you're together, we respond with yes. If we are together, we respond with yes. Perfect. Then I only have to make one statement. In case of trade-in, in case of what we call the trade-in, the disposal value, when you talk about trade-in, in case of trade-in, the value of the old asset is deducted as the disposal value. You're saying that in case of trade-in, we say that in case of trade-in, lastly, we say in case of what we call of trade-in, the value of what we call of the old, asset, we say qualifies as what we call as the disposal value. The value of the old asset qualifies as what we call the disposal value. So that is that. I want us now to go to the practical work. Is there any question before I get to the practical work? Kuna mtu ana swali? Is there a question? Kuna mtu ana swali? Can I proceed to the questions? Is there any question regarding? We move on. Perfect. So I want the first question. I want us to start on the first question. I want us to pick on December 2024. I want us to pick on December 2024. That is question 4C. December 2024. We start with the first question, DEC 2024. Question 4C. DEC 2024. Question 4C. Are we on it? Let's start with that question. DEC 2024, question 4C. DEC 2024, question 4C. If you're there, you respond with a yes. DEC 2024. So perfect. So I want us to read That's the question. So we're being told, Adam Mwema, the examiner tells us that Adam Mwema, a retired engineer, Adam Mwema, a retired engineer, sets up a manufacturing factory in industrial area on 1st January 2023 to fabricate mechanical and automotive parts at a cost of 44,900,000. At a cost of 44,900,000. So then the examiner tells us the operation commenced on 1st January, that is 2023, except for commercial building, which was put into use from 1st September, except for the commercial building, which was put into use on 1st September. So then you're given the breakdown for the manufacturing. So the breakdown of 44,900,000. Number one, you're being told that the factory building, that is 18 million. Which investment allowance does it qualify for? Factory building. Factory building, it qualifies at which rate? Which investment allowance and at what rate? Factory building, which investment allowance and at what rate? Which investment allowance and at what rate? Factory building. Which investment allowance does it qualify? At 50%, we call it ID, but you say at 50% in the first year, then you say 25% on the straight line, 25% on the straight line. That is from the second year on the remaining balance. Number two, we call it office within factory building. Office within the factory building. How would you treat that? Office within the factory building. Office within the factory building. When you say office within the factory building, office within the factory building, what does it qualify? At what rate? That's a commercial property. So it qualifies for investment allowance at the rate of? At what rate does it qualify for investment allowance? At the rate of, we say at the rate of 10% on a straight line. You mark them. If you have a physical paper, you mark it them. Then the next we have what's called second-hand imported machinery. Second-hand imported machinery. Second-hand imported machinery. Second-hand imported machinery. So what does it qualify for? The second-hand imported machinery. For the second-hand imported machinery, it qualifies for which investment allowance? Second-hand, remember this is manufacturing. The second-hand imported machinery qualifies for ID. We understand at the rate of 50%, that is in the first year, then 25% on a straight line per annum, that is from the second year on the remaining balance. Then you have the next, what you call land. Land, does land qualify for investment? And which investment allowance does the land qualify for? Does land qualify for investment allowance? Does land qualify for investment allowance? Does land qualify for investment? No. Land does not qualify for any investment allowance. So that we are not going to use. The next we have what we call engineer fee for machine installation. What we call the engineer's fee for machine installation. Engineer's fee for machine installation. Engineer's fee, that is ID, at the rate of 50% in the first year, 25% per annum on the straight line, that is from the second year on the remaining balance. The next is what we call the parking bay. Parking bay. Parking bay. Parking bay. What does the parking bay basically qualify? Parking bay. That is also investment allowance at the rate of 50% ID, at the rate of 50% in the first year, 25% per annum on the straight line. That is from the second year on the remaining balance. Then the next we have what we call conveyor belt. Conveyor belt, Matsura. Conveyor belt, Matsura. Brand conveyor belt, what does it qualify for? Conveyor belt. Conveyor belt. Conveyor belt. Conveyor belt. Conveyor belt. So which investment allowance, Japan? That is at the rate of 50% in the first year, at the rate of 50% in the first year, and 25% per annum on a straight line, that is from second year on the remaining balance. Then lastly, we have commercial building, and the figure is 10 million. Commercial building, what does it qualify for? Commercial buildings, commercial buildings, commercial buildings, commercial buildings, 10%, 10%. Thank you so much. So I proceed to the additional information. Alan, Ida, thank you so much. I proceed to the additional information. On the additional information, we've been told that commercial building, we are given a breakdown. Commercial building include what we call a showroom. So the figure of 10 million, the figure of 10 million, we can put it as probably working commercial building, commercial. We have it as a commercial building. The figure is 10 million. From 10 million, this one includes what we call showroom. So we have the showroom. We have what we call the showroom. And the showroom and retail. Showroom is 2.8. 2.8. Then we have what we call retail shop. What we call the retail shop. So retail shop is a figure of 3.2. So what is the figure for the commercial building? What is the figure for the commercial building? What is the figure for the commercial building? So what is the figure for the commercial building? If you less that, what is the figure for the commercial building? So when you less that, what is the figure for the commercial building? Because this figure is inclusive of a showroom and retail shop. So what is the difference? Is the difference 4 million? Is the difference 4 million? Perfect. Showroom and retail shop, they qualify for investment allowance at what rate? Showroom and the retail shop, they qualify for investment allowance at what rate? Showroom, they qualify at 10%, at 10%. So that is analyzed. So then you're being told that factory building include a warehouse. So there's a working two. We have the factory building. What is the figure for the factory building? What is the value for the factory building? What is the value for the factory building? What is the value for the factory building? What is the total value for the factory building? So that was a figure of 18. We had it as 18 million. But we've been told that on this building, on this factory building, there's what we call, there is a warehouse. So we need to less that warehouse. We need to less that warehouse. And the figure is 2.2. The figure is basically 2.2. So what is the factory building? The figure for the factory building. What is the figure for the factory building? The figure for the factory building. Give me the figure for the factory building. Provide me the figure for the factory building. Provide me the figure for the factory building. The figure for the factory building. Provide me with the figure. So this is 15,800,000. Aida tuko sawa? Aida, are we together? Perfect. Abia. Editor up here together. So this warehouse, what will it qualify for? If we list it, warehouse will qualify for? The warehouse will qualify for investment allowance, that is IBD. We understand that 10% at 10%. IBD at the rate of 10%, at the rate of 10%. IBD at the rate of 10%. So we proceed to the next. The examiner tells us that additional information number 3, a building that had been constructed, a building that had been constructed, a building that had been constructed at a cost of 12 million was leased to Juhudi Manufacturers Limited. A building that had been constructed for a figure of 12 million was leased to Juhudi Manufacturers Limited for 5 years. So being told that annual lease rental was agreed at 2.2. Adamil Mwema imported the machinery from China at a cost of 5.2 and installed it in the building and started operation allowance for the building that you basically leased. Do we grant investment allowance for a building that you have leased? Do we grant investment allowance for a building that you basically leased? And we grant investment allowance for a building that you basically leased? No, we don't grant. That's why if you have options, in order for you to qualify for investment allowance, you buy instead of leasing altogether. If you want to qualify for investment allowance, you buy instead of leasing. Are we together? If you lease, you're only going to be entitled to what we call the lease rental, rentals as allowable expense. But if you have the option to lease or buy in order to qualify for what you call investment allowance, in order to qualify for the investment allowance, in order to qualify for the investment allowance. However, what about the imported machinery of a figure 5.2? Is it going to qualify for investment allowance? The imported machinery for 5.2, is it going to qualify for the investment allowance? Is it going to qualify for the investment? Yes, that imported machinery is going to qualify for the investment allowance. Yes, that is going to qualify for the investment allowance. So that is sorted. All of us, are we together? All of us, are we together? Perfect. So then I proceed to additional information number 4. So the examiner tells us to improve the performance of the factory. We are being told that to improve the performance of the factory, Adamil Mwema computerized operation at a total cost of 15 million. Adamil Mwema computerized the operation at a cost of 15 million, out of which 30% was software related. So out of which, so we have computers, and then we have the softwares. We have what's called the software. So the figure is 15 million. But the examiner tells us that basically 70% was the computer. So 70% times 75% times a figure of 15 million. So what is 70% times a figure of 15 million? Because that's what 70%, then 30% was in relation to software. 30% was basically into the softwares. 30% was basically in relation to the software. Just a minute. Give me a few minutes. Sorry for the interruption. Sorry for the interruption. So then 70% into the computers. So what is 70%? 70% of what we call 15 million. So that should be 10, 10, 500. What do you call the 10, 500? We have it as 10, 500. What about the 30% that is in relation to the software? 30% that is in relation, that should be 45. That should basically be 45. So computer software and computers, they qualify for investment allowance. Number one, computer and computer software, those are wear and tear. At what rate? Those are basically wear and tear at what rate? Wear and tear at what rate? At the rate of 25%. At the rate of 25%. Training at the rate of 25%, not 10%. Training that should be wear and tear. Furniture and fitting. Furniture and fitting. What does furniture and fittings qualify for? Investment allowance at the rate of 10%. Investment allowance at the rate of 10%. What do you call investment allowance at the rate of 10%? At the rate of 10%. The next is the second-hand BMW vehicle. Second-hand BMW vehicle. What does it qualify for? The second-hand BMW vehicle. The second-hand BMW vehicle. The second-hand BMW vehicle. 25. But what do we do to the BMW? There's a concept that we have not remembered. What do you do? The BMW Nini, that's an SUV. So what do? We restrict to 3 million. The amount that is going to qualify for wear and tear should be, that should be 3 million. We restrict to 3 million. Then the next, we're being told that 4-ton lorry, a figure of 1.8. 4-ton lorry, a figure of 1.8. The 4-ton lorry, figure of 1.8. What does it qualify? 4-ton lorry. A 4-ton lorry. Investment allowance at what rate? At the rate of 25%. Thank you, governor. Then we have the next, that is what we call the backhoe loader. Backhoe loader. What do you call the backhoe loader? So backhoe loader. What do you call the backhoe loader? Backhoe loader. The backhoe loader. At what rate? That's wear and tear. But at what rate? Wear and tear 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 at what rate? Not 10%. Backhoe loader, that should be 25%. Note it as 25%. As 25%. As 25%. Either that should be 25%. Is that okay? Either that should be 25%. Either is that noted? Either that should be 25%. That should be 25% together. That should be 25%. Matsura, that should be 25%. So then we have the next is mobile crane. Mobile crane. Mobile crane. So the mobile cranes. Mobile crane. Mobile cranes. mobile cranes, mobile cranes, mobile cranes. Thelma, why did you say that? Mobile cranes. That's not a trailer, the smaller trailer. Mobile crane. Mobile crane. Galma, you are missing it. Mobile crane. Mobile crane should be 25%. Kim, that should be 25%. 25% together. Mobile crane should be 25%. 25% together should be 25%. 25%. Tuko sawa. To give me a yes kindly. Then lastly, we are being told that the factory, the examiner tells us that the factory staff labor quarters were constructed during the year. Factory staff quarters, that's IPT, at the rate of 10%, 10%, at the rate of 10%. I know you wonder why I chose on this question. I particularly chose on this question because people did not perform well in this particular question. This is one of the questions that was poorly performed. So before I put it down, we're not going to break before we finish. Before we put it down, please, you see there's wear and tear here, number 5 from 1st July. And we have the labor quota that is for the IBD. We are being told that from what? That is from October. We don't apportion. Please don't apportion. Please don't apportion. Is that okay? Do not apportion. Claim the whole amount. Claim the whole amount. Together. Do not apportion. Claim what we call the whole amount. Do not apportion. Claim what we call the whole amount. Do not apportion, claim what we call the whole amount. So do not apportion, claim the whole amount. Is that point at the back of our mind? Pardon, is that point at the back of our mind? Perfect, if that point is basically at the back of our minds. If that point is basically at the back of our mind. So when it comes to investment allowance, I can use 2 methods of doing it. I can separate them, or I can use them as a whole. I've said when it comes to investment allowance, I can basically separate them, or I can do what? I can separate them, or I can accumulate the whole amount and carry out the investment allowance. Or I can decide to do them separately. Or I can decide to basically do them separately. Are we together? So the both methods, I will apply them. But for this first question, I will do it separately. For this first question, I will do it separately. We don't prorate. We don't prorate. Don't prorate them. That's why I'm doing this question, Galma. Yes, because majority of the students failed in this question. And the reason why they failed is because they prorate this. So then we all know that Adamil Mwema, we call it the Adamil Mwema, and we understand that this is investment allowance say for 2023. Adamil Mwema, and we have what's called the investment allowance for 2023. Adamil Mwema, and then we have investment allowance for 2023 together. That is what the examiner compute investment allowance due to Adam Mwema. So the first method, I am doing it separately. So I start with ID, call it ID. So investment deduction at 50% in the first year, 25% per annum on the straight line, that is from the second year. So investment, we call it the investment. Investment, they call it the investment deduction. We call it the investment deduction. So we separate them. So say nature of the asset, nature of what you call the asset, nature of the asset. We have the qualifying cost. Nature of the asset, we have the qualifying cost. We have what you call the ID rate. ID rate. We have the ID rate. And then we have what you call the ID amount. And then we have what you call residual. That is the balance, though not necessary because they're not moving to the second year. So we start with the first item. The first item is what we call the factory. We have it as the factory. We have it as the factory building. So what is the value for the factory building? Factory building from our working. What is the figure for the factory building from our working? Nataka watu wakuwe rada. Factory building. Tumepata ngapi? From our working, the figure for the factory building, that is 15,800,000. The ID rate for the first year is 50%. So what is the amount? 50% of that is what figure? 50%. How much is 50%? ID amount, 50%. Watu wangu 50% of that. Chukua calculator na ufanye. That is 7.9. 7.9. So then the residual is 7.9. So that is the first one. So next is what we call second-hand imported vehicle. So next is what we call second-hand imported vehicle. What we call second-hand. We call it imported vehicle. So the second-hand imported machinery, sorry, not vehicle, machinery. That out. Machinery. That is 4.4. The figure is 4.4. What is 50% of 4.4? 50% of 4.4. Of 4.4. So 50% of 4.4. So 50% of 4.4, that should be 2.2. That should basically be 2.2. This is 2.2. That should be 2.2. 2.2. Then we have land does not qualify. We go to engineers fee. We call it engineers. Engineers fee. We call it for installation. So why do we put there? These are the costs that are incurred before the machine is put to you. These are costs that are basically incurred before the machine is put to use. So that is 1.4, 50%, 700. Then we have a figure of 700. Then we have a figure of 700. Then we have what's called the parking bay. Parking bay. We have the next what's called the parking bay. So parking bay is a figure of 900,000. 50%, 950%, we have 450, and then the balance is 450. I hope we are moving on well. Then you have conveyor belt. So the conveyor belt is 1.4. 50% of that should be 700. 700. That should be 700. So conveyor belt, we have 1.4, 50% of that should be 700. We respond with a yes. That should be 700. Together, 700. That should be 700. Tuko sawa. Kuna mtu ako nyuma. So we turn the pages. So the next ID is what we call imported processing machinery. Imported. We call it imported processing. We call it machinery. So imported processing machinery, the figure is 5.2. Are we in agreement that the figure is 5.2? Are we in agreement that the figure is 5.2? Are we in agreement that the figure is 5.2? Imported machinery. Are we in agreement that the figure is 5.2? 5.2. If we are, then that should be superb. So that is 50%. This should be 2.6. 2.6. The balance is 2.6. Is there any item for ID that we've not added? Is there any item that we've not added? Is there any item that I've skipped? Is there any item that I've skipped? Is there any item that I have skipped? Is there any item that I have skipped? Is there any item that I have skipped? So there's not an item. So we call it, this is summary, we call it the total ID. So what is the total summation for the ID amount? Total ID, summation for the ID amount. Total summation for the ID amount. Total summation for the ID amount. Of what we call asset. So nature of the asset. We have qualifying cost. We have the IBD rate. We have the IBD rate. We have the IBD amount. And then we have what we call the residual. And then we have the residual. So on this, we have office within the building. So we have office. So the qualifying cost for office, that should be 800,000. The rate is 10%. What is that? The rate is 10%. What is 10% of that? What is 10%? Give me that. What is the rate? So that should be 720. That should be 720 as a balance. The next we have commercial. We have the commercial building. So commercial, throughout our working, we divided that as 4 million. So 10%, don't apportion. You don't apportion 10%. So that is 400. Together. Tuko sawa. And today you're not responding. Are we together? Training. Tuko sawa. Training tuko sawa. Matsura tuko sawa. Brian, are we together? Kindly, when you don't respond, we are losing it on learning. So then the other breakdown, we had what we call, we had the showroom, 10%. So what is the difference as residual? 2.8 minus 2.8. Give me the difference. Then we have what we call the tail shop. %, that should be 320. So give me the balances. Monopaties or balances. $2 million. What about this? Is it this? Is that the figure? 2,880,000. Is that the figure? 2,880,000. Nimeshukuru, asante. So then we have what we call the warehouse. Warehouse. We had the warehouse. So what is the residual? What is the residual? What is the residual? Residual ni ngapi? Watu wengi wamekataa. Is it 1980? My people have rejected me. Are we having that? Then you had the staff quarter, labor quarters. Labor quarters, 2,250,000, 10%, that should be 225. So 225, what do you have? $225. So get for me the summary. Total, give me the total IPT amount. Nipatie hiyo figure. Alphabet is 80, 400 to 80, 320 to 20 to 25. That is a figure of 1,525,000. So these are the entries. That should be okay. Those are the entries. Tuko sawa? Munipatie yes. Galma, kindly don't prorate. I've said kindly don't prorate. Prorate. What have I said? Kindly don't prorate. I have insisted, Galma, kindly don't prorate. Particularly for this question, the reason why students that in this particular year failed this question, because most of these questions, particularly this was the prorated, which get a Galma. Because of apportionment or proration, that's why majority of the students failed in this particular question. Yes, that's why majority, I will always tell you, because lazima tujenge wanafunzi wetu. Is that true, Galma? We must assist our students and make sure that they perform together. So don't prorate. Why did they fail in this? Because of that. That's why I insist, if you're looking at this, what people are doing in the internet, follow what I say. Are we together? You can check other things, but this one, just follow what I tell you. Yes, just follow what I tell you. Can I have this? Can I run? So that we do the last part of it. Can I run? So, Ida, in my class, that's what I told you, particularly for this, Ida, you don't prorate. With the changes that were expected, you don't prorate. Ida, don't prorate, kindly. Sawa, Ida. Yes. Mwalimu atakutetea. No, I'm joking. Yes, don't follow what I say. Just follow what I say. I cannot lead you to a wrong direction. Mwalimu will always lead you to the right direction. I know that's a concept that majority, you pick a paper, especially a paper like this, and then you realize it because they prorate, and then they miss marks on that. So then we go to wear and tear. I say these things can be done in one, can basically be done in a single. Are we together? We can do this, Galma. We can even do this as a whole. We don't need to separate, but I said we separate. Then the next question we'll do as combined together. We do as combined. So we have the last one that is wear and tear. The last one is wear and tear. The last one is wear and tear. The last one is basically wear and tear. So the last one is basically wear and for the last one is wear and tear. So we have what we call wear and tear, wear WTA. So that is wear and tear. WTA, that is wear and tear. So we have what we call nature of what we call asset, what we call the nature of asset. We have the nature of asset. We have qualifying cost, qualifying cost. We have what we call wear and tear at 25%. We have wear and tear at 10%. Then we have ARC, residual. Then we have the residual. Hapo tuko sawa. Hapo tuko sawa. If you're there, we pick the first one. So we have the furniture and fittings, furniture, and what we call the fittings. What we call the furniture and fittings. So the qualifying amount is 620. So the qualifying amount is 620. That is wear and tear at 10%. So what is 10% of 620? We understand not here. 10% of 620. 10% of 620. That should be 62. So 620 minus 62, what is the residual? 620 minus 62. 620 minus 62. 620 minus 62. Though not a max, because even if you put it residual, but we put it, that's not where the max is. So that should be 588. So then we move to the next, we have second hand and BMW. So we say restricted. So the figure is restricted. So we restrict it to 3 million. We restrict it to 3 million. That should be wear and tear at 25%. So this is a dash. So this should be 750. So 750 minus 3 million and 5% is 750. What is the difference? We restrict because that's an SUV. SUV. So you restrict. SUV, restrict, restrict, restrict. So this is 2 million. Should be 2 million